Your Excellencies, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. Good morning and welcome to today's workshop of the second phase of the FTA's comprehensive corporate tax awareness campaign. I would like to begin by expressing my great pleasure to see you and thank you for attending with us this workshop today. My name is Roda Al-Mheri and I will be your Mistress of Ceremonies during today's workshop. From 2023, the Federal Tax Authority launched the Corporate Tax Awareness Program, comprised a total of 76 awareness workshops, including 17 in-person workshops held across the 7 Emirates, and focused on explaining the general principles of taxation of corporations and businesses. In addition to 59 virtual webinars, which focused on general and specific topics related to corporate tax registration. Today's workshop in Dubai marks the 4th session of the 2024 Corporate Tax Awareness Campaign, which we will introduce to you the general principles on taxation on corporations and businesses. Today's agenda will be starting with the basic elements of corporate tax law, followed up with the small business relief, free zones, calculation of taxable income, tax groups, compliance requirements, and last but not least, a question and answer session at the end of the workshop. Ladies and gentlemen, without further ado, I would like to invite His Excellency Khalid Al-Bustani, Director General of the Federal Tax Authority, to deliver his welcome speech. Please welcome him to the stage.
صباح الخير أصحاب السعادة الحضور الضيوف الكريم أرحب فيكم في هذا اللقاء اليوم اللي بنتكلم فيه إن شاء الله عن ضريبة الشركات. أنا إن شاء الله بلقي كلمتي باللغة الإنجليزية فحبيت أرحب فيكم في البداية. Your Excellencies, distinguished guests, ladies and gentlemen, it gives me a great pleasure today to welcome you here in this workshop for UAE corporate tax, which is this workshop comes under the second phase of our series of workshops on the FTA. And I'm pleased to say this is definitely one of the biggest live workshops that we had. And it shows you our commitment that we will continue supporting you through our journey with the corporate tax. Can you hear me? Can you hear me in the back? Yeah. Thank you. Sorry. So our goal is to provide you with valuable information on the principles of corporate tax. However, we are evolving now. As my colleague said, we will elaborate more on key areas which we received a lot of inquiries on. Small business relief, natural persons, free zones. As you know, the free zone guide have been issued recently by the FTA, and we know there are a lot of questions asked. So we will focus on the free zones in this session briefly. However, we promise you we'll have a lot more sessions in the coming future. UAE corporate tax was launched last year, starting from companies with the financial years in June, and this year for all the other companies. And UAE government always made sure that the corporate tax is a business-friendly tax. It encourages growth and innovation and investment, and most importantly is voluntary compliance. And this is where the FTA, we need to work with you in ensuring that we give you enough support and we work together so that we have good compliance to the tax. Early on, since the introduction of the corporate tax, we worked hard to update our platform, EmiraTax. We started early registration last year with selective companies to pilot the system, to get their feedback, and we opened the registration in June, in May, and we invited everybody to register. And we all know we have a long journey, and we want to encourage everybody to register in time and give them enough time to register and not to leave things to the last minute. However, we have noticed that a lot of companies are not registering, and this causes a problem for us because when it comes to filing date, we don't want companies without a TRN, and will cause a lot of problems for them. This is why we have issued FTA decision number 3, 2024, effective from March, and we planned a time frame for corporate tax registration. The time frame has been designed carefully, taking consideration the number of licenses, and this is where now we're coming to the end of the first batch of companies which are registered with a license date in January and February, and tomorrow is the deadline. And beyond that deadline, if this group of companies are late in registering, they will be subject to penalties. The next batch of companies which are with the registrations in March and April, they have the whole month of June to register, and this is important that we will announce that. We will continue to do that. We will support them with that. And in order to support taxpayers, because we understand a lot of companies, although the registration easy, they may not have the capacity or the knowledge to register. We signed agreements with different government service centers to support taxpayers who cannot. Although we prefer, if you familiarize yourself with our EmiraTax platform and use it online and register, it's a straightforward registration. And we ensure that when we design the registration, we have a simple registration for registrant with a VAT to convert to the corporate tax. So we will continue to do that, and we will support the taxpayers. And we have a weekly, as my colleague said earlier, we have weekly 2 webinars, one in Arabic, one in English, to support taxpayers on the principles on how to use the registration system. So I encourage you, if you are new and you want to register, to join us. One of the key areas that we will be working on is awareness. It is our commitment in the FTA to support you. We want to make sure that everybody is ready there at the right time. So what we have done in the past period, we have conducted 76 workshops, a lot of webinars, and we will continue to do that, and we will evolve, as I said, into specialized areas depending on the needs of our taxpayers. We also have several focus groups to listen to them about the challenges the taxpayers are meeting with the new tax, and we're learning from them, and based on that we are improving our systems to ensure that it's an easy, simple operation. We also ensure that while we introduce the tax, we have issued a lot of guides. I think one of the most important obligations on the taxpayer is to spend the effort to use the guides, because the guides offer a lot of wealthy information and examples, and we learn from our experience in the past how to develop the guides. So we developed our new guides with a lot of examples, a lot of simple information for people to understand. However, as you know, in the tax, it's not very easy to explain things without the tax definitions and the jargon, but we try to our utmost effort to ensure that taxpayers are provided with the guides. So I request all of you to benefit from our platform, our website, and use the guides and make sure you learn from them and prepare yourselves. So distinguished guests, recently we issued a major milestone. It's the guide on corporate tax on free zones. Free zones play an important part of our economy. This is why our Ministry of Finance, while they designed the corporate tax, ensured that it is designed with the best practices, and they had a lot of recognition for their design of the corporate tax from the OECD and globally. And this shows our commitment to support the free zones while we comply with international standards. So we seek all the free zone companies to use the guides, to learn from it, and to prepare themselves. I would like to conclude by a few points. First of all, please make sure you stick to the registration timetable and the plan we have planned for everybody to make sure everyone have the tax registration number in time. Make sure that you learn more about the guides. Make sure that you attend our future webinars, specialized ones depending on the area of expertise. And the most important, start book your books and bookkeeping, because one of the challenges we face here in the UAE, there is no culture of a proper bookkeeping, and this is something that is important for tax obligation. So please make sure that you are ready in time, because although we have time until filing date, but time is running out quickly and you need to be prepared and ready quickly. So I would like to conclude here, and I will leave it to our experts to give you more technical details about the tax. Thank you very much for listening.
Now, please let me introduce to you Rida Hamzawi, Tax Policy Senior Expert, Christine Awad, Tax Policy Expert, Juliana Candido, Tax Policy Expert, and Zubair Chaudhry, Tax Policy Specialist, to present to us the general principles on taxation on corporations and businesses. Please welcome them to the stage.
Assalamu alaikum. Good morning, Excellencies, ladies and gentlemen. Our session today, so as mentioned by His Excellency, we will try to focus on the key elements of the corporate tax law. We will speak about the small business relief, natural person taxation under the corporate tax law. The free zone will give examples on free zone on specific types of activities, whether they are qualifying activities or not, how to compute the qualifying income, determine the qualifying income. We'll try to explain and cut through complexity in terms of providing details on how to determine whether you are a qualifying free zone person or not. We will give details on the computation of taxable income. We talk about the regimes related to tax groups. Compliance requirement, we will talk about the corporate tax registration, which is the first step in terms of compliance with the corporate tax law, and then there will be a session on question and answers. The first part is related to the key element of the corporate tax law, and I think one of these elements, of course, is the residence, and we'll talk about the residence for corporate tax purposes. But just to set the stage for the presentation, I think it's good to talk about the legal framework of the corporate tax law. So basically, we have the federal decree law issued by the President of the UAE. We have also 8 cabinet decisions. So the federal decree law refers to 8 cabinet decisions. There are also 20 ministerial decisions related to various topics, from the participation exemption tax group, accounting standards, etc. And then we have, of course, FTA decision, and up to now we had like 6 FTA decisions related to corporate tax law. And then, as highlighted by His Excellency, FTA published a certain number of guides, so up to now 18 guides on corporate taxation, and the last guide is the guide on free zones. And most of these guides also, they are also published in English and also in Arabic version. And there will be also many other guides in the future. But I think I wanted to highlight the importance of going through the guides, and we are trying to provide as much as possible examples, simple, and then gradually going through complexity from simple to more sophisticated examples. So I think it's extremely important to go through the corporate tax guides, to read the examples, and to follow the flow, to read the whole guide, because sometimes the information is provided in one section. So I think it's important, very important, to read the corporate tax guides in a comprehensive manner. The corporate tax regime is based on, first of all, determining your status in whether you are a resident or a non-resident person. And this rule, the corporate tax residence rule, it applies equally to juridical person, but also to natural person. So the first thing to determine under the corporate tax law is to know whether you are a resident juridical person or a non-resident juridical person. If you are a natural person, you need also to determine whether you are a resident natural person or a non-resident natural person. The determination of the resident status is based on the corporate tax law. However, it will also interact heavily with the applicable double taxation agreements. And in general, the applicable double taxation agreement, they will prevail against the domestic tax law. So you need to determine your status based on the corporate tax law. However, very often, tax treaty will also enter into play, especially specifically for the residence requirement. The residence criteria, so for the juridical person, they are revolving around 2 elements, and if one of them is met, I think the juridical person will be considered as resident in the UAE for corporate tax purposes. So the first one is that the juridical person is incorporated, established, or recognized under the UAE laws, and this, of course, covers all free zone persons, so all entities that are incorporated or that derive their status from free zones. The second criterion is the effective management and control. So if we have a foreign incorporated juridical person that is established or that is deriving his status from a foreign jurisdiction, from the legal regime of a foreign jurisdiction, if that juridical person is effectively managed and controlled in the UAE, this person will be considered as a resident in the UAE, and it will be subject to tax on its worldwide income in the United Arab Emirates. So when a foreign entity or foreign juridical person is considered to be effectively managed and controlled in the UAE, depends heavily on facts and circumstances, but the main criterion is to look at the key management and commercial decisions that are basically made and taken and prepared in the United Arab Emirates. So if we look at the situation where a parent company that is incorporated in the UAE, and this parent company owns, for example, 90% of the share capital of a subsidiary, a foreign subsidiary that is incorporated in a foreign jurisdiction. If, for example, for year 2025, the board members of parent co, they make all the strategic decisions for the subsidiary, for subco. If all the board meetings of subco, they are held in the UAE, if all the key management decisions of subco are made in substance in the UAE. Very likely, subco or subsidiary co will be considered as effectively managed and controlled in the United Arab Emirates. And then it will be subject to registration. It will need to register, apply for registration, get a TRN number for CT purposes, and then comply with all the corporate tax requirement under the corporate tax law. Of course, in a cross-border scenario, there is always a possibility that this company, of course, is, because it is incorporated in a foreign country, it might be considered as a resident in that foreign jurisdiction. And in that case, we will have a situation of a dual residence, which might trigger double taxation, and this should be solved under any applicable double taxation agreement between the UAE and the foreign jurisdiction where the subsidiary is incorporated. Many double taxation agreements refer to a solution or to a rule to solve dual residence to the place of effective management. And then in that case, subsidiary co will be considered as resident in one jurisdiction, which is the UAE. However, we find a lot of variation in double taxation agreements, and many double taxation agreements refer to the place of incorporation, to the country where the headquarters are based, or sometimes, and increasingly due to the OECD BEPS project, they refer to the solving dual residence based on a mutual agreement procedure. So both tax authorities, they will talk to each other, and they will try to determine where the dual resident entity is based. So any resident person, which is a juridical person, if he is considered as resident under the corporate tax law, he will be subject to tax on his worldwide income, which means the income that is derived from sources in the UAE and income also from sources outside the UAE. And the person will be required, of course, to register for corporate tax and apply for registration as per FTA decision number 3 of 2024. And my colleague Juliana will give in the second part of the session today additional details on the timelines of registration for corporate tax purposes as per FTA decision number 3 of 2024. I wanted to mention also that for the registration deadline, if a company is effectively managed and controlled before in the UAE, before 1st of March 2024, according to FTA decision number 3 of 2024, this company would need to register within 3 months from the effective date of the decision, which is 31st of May 2024. If the company is effectively managed and controlled after and becomes resident after the 1st of March 2024, then this company will need to register within or apply for registration within 3 months from the end of its financial year. So in the example we saw, if in 2025 the subsidiary co will be resident in the will be considered as resident in the UAE, and the subsidiary co has a financial year going from January till December, it will have 3 months from the end of the financial year 2025 to apply for registration to the FTA. Now, we saw the position for resident person. We have also to consider the situation for non-resident juridical person. So, a person who is not a resident person and meets specific criteria, he will be considered as a non-resident person for corporate tax purposes. The first criterion is the permanent establishment situation. And a non-resident juridical person will be considered to have a permanent establishment in the UAE if he has a fixed place of business in the UAE, and usually a fixed place of business is considered to be met when there is a time permanency of kind of 6 months for conducting the activity in the UAE. So the requirement of 6 months, of course, is provided by the black letter of the law with respect to construction activities. So if a non-resident person is coming to the UAE, for example, to build a bridge or a motorway or a dam or any major infrastructure, as far as the 6 months timeline is reached, it will be considered to have a permanent establishment in the UAE. Also for other activities other than construction activities, the non-resident person also will be considered to have a PE once the time threshold of 6 months is reached. And this specific point has been clarified in the guide on taxation of non-resident person for corporate tax purposes. The second situation where a non-resident juridical person would have also a permanent establishment in the UAE is the dependent agent situation. So basically, the dependent agent will be a person that is habitually concluding or negotiating contracts for the non-resident person in the UAE, and then that dependent agent will create a permanent establishment for the non-resident person or the non-resident principal in the UAE. And all the sales that are, for example, derived by that dependent agent, they will be attributable to the permanent establishment created by that dependent agent in the UAE. The second situation, so the first situation or the first instance where a non-resident a person that is a not a resident person will be considered as taxable in the UAE is the permanent establishment situation. The second one is when the non-resident person is deriving UAE sourced income, and the UAE sourced income has been defined under Article 13 of the Corporate Tax Law. And of course, this is connected, of course, with the withholding tax obligation, but currently, according to Article 45 of the Corporate Tax Law, the withholding tax rate is 0%. The third situation where a person that is not a resident in the UAE will be considered to be taxable in the UAE is when he has a nexus in the UAE, and the nexus is an immovable property that is based in the UAE from which the non-resident juridical person is deriving or earning income. So the nexus concept, it is applicable only for non-resident juridical person. It does not apply to non-resident natural person. So if a foreign company is owning a building in the UAE and is renting this building, as of the day the rental agreement is signed, or as of the day the foreign juridical person is earning rental income from that immovable property in the UAE, it will be considered to have a nexus in the United Arab Emirates, and it will be required to register, get a corporate tax registration number, and of course comply with all the requirement, including filing a tax return within 9 months from the end of its tax period. It is extremely relevant to also highlight that for the non-resident position of, assessment of the position of a non-resident person in the UAE, it is always extremely important to highlight the importance of double taxation agreement and consider the impact of double taxation agreement. So we start from the domestic tax law, which is the corporate tax law in the UAE. However, if the non-resident person is coming from a country which has an applicable double taxation agreement with the UAE, we need to assess the impact of this double taxation agreement. And again, these features and the interaction with double taxation agreement, it has been highlighted also under the guide on the taxation of non-resident for corporate tax purposes, which has been published around 8 months ago. So what is subject to tax with respect to non-resident persons? So in the case of a permanent establishment, only the income attributable to the permanent establishment in the UAE. So the first step when we need to deal with a permanent establishment is first to determine whether there is a permanent establishment or not. If we determine that there is a PE in the UAE, then we need to attribute income to that permanent establishment. And attributing income means attributing gross revenue and also expenditure. And then in the case of the nexus in the UAE, so if a foreign juridical person is earning income from an immovable property in the UAE, the income that is attributable to the nexus is taxable in the UAE, and basically this covers all the income from the rental income or the income from the any income from the exploitation of that immovable property. And here, of course, we are more talking about a passive income. So basically, we are not in a situation where the non-resident person is conducting an active business in that immovable property. So he's basically just renting the immovable property, and this will create a nexus for him. If there is a business activity conducted in the immovable property, then we will be in a situation where the non-resident will be very likely in the position of having a permanent establishment if the requirements are met. And then the last situation is the state source income, and in that case, all the income that is considered as a state source income, as income derived from the UAE by the non-resident person, it will be subject to tax, but currently the withholding tax rate is 0%, so basically it will not be subject to any taxation. In respect of the corporate tax registration, so in the first situation, if you have a PE in the UAE, if you have a nexus in the UAE, you will be required to register for corporate tax purposes. If you are only deriving state source income in the UAE without having any permanent establishment in the UAE, you will not be required to register, because basically your tax liability is meant to be collected via withholding tax, and as we said, according to Article 45, there is no withholding tax currently in the UAE. The corporate tax rate, I think we, of course, for the resident person, the standard regime is that we have 0% on taxable income up to 375,000 dirham. What exceeds the 375,000 dirham, it will be subject to tax at the rate of 9%. For non-resident, there will be also, whether with the nexus or with a permanent establishment in the UAE, they will also benefit from the 0% up to 375,000 dirham. And what exceeds the 375,000 dirham will be subject to 9%. And this will be considered, of course, the taxable income is a net income, so it's not a gross income. So it's an income which is determined after, based on the accounting income, and of course, after making some adjustment to the accounting income to take into consideration the differences between the accounting rules and the tax rules. The non-resident with UAE source income, they will be subject to, as I said, 0% withholding tax. And of course, when we talk about non-resident with UAE source income, we assume that they don't have a permanent establishment in the UAE, because otherwise they will fall into the second situation. If they have a PE in the UAE, they will need to pay tax at the rate of 0 and 9%. And of course, they will need to register and obtain a tax registration number. And I leave the floor to Zubair to talk to you about natural person.
Thank you very much, Rida. Good morning, Your Excellencies, distinguished guests, ladies and gentlemen. So the next section of this presentation is going to go through natural persons. And let's take a step back for just a moment what is a natural person? When we talk about natural persons in the corporate tax law, in the many decisions that have been released, what is a natural person? A natural person takes its ordinary meaning. It means an individual. So when we look at natural persons, we're talking about individuals who are conducting businesses or business activities in their own capacity as individuals. And there's a distinction between natural persons who have set up separate legal entities. So as soon as an individual sets up an LLC, that LLC will become a juridical, or be considered a juridical person for corporate tax purposes. And that will follow what Ridha has just presented to you. So an individual in their own capacity, the business and business activities they carry out is what we are concerned with when we talk about natural persons. In terms of the tax rates that Ridha has just mentioned, that will also apply to natural persons, to individuals. They will have the first 375,000 dirhams taxed at 0%, and beyond that will be taxed at 9%. So when are individuals subject to corporate tax? Well, there are two requirements. The first is that they must be conducting a business or a business activity. And that can be one or it can be multiple businesses. So if there's one single individual and he has 5 or 6 different businesses, if they are carried out in a capacity as an individual, as a natural person, they will all be taxed for that individual together. Now, the second part, as provided by Cabinet Decision 49 of 2023, is the turnover. So, an individual, a natural person, is only subject to corporate tax if their turnover exceeds 1 million dirhams. And that is per calendar year, per Gregorian year. So from the 1st of January to the 31st of December in any calendar year. The turnover has to be considered specifically for that year. So corporate tax was introduced on the 1st of June 2023. What does that mean for individuals? What does that mean for natural persons? Well, for resident natural persons, they need to consider their turnover from their business activities which started on the 1st of January 2024 for this calendar year. And I will come on to tax periods for natural persons, for individuals, in just a moment. So, if a natural person conducts business or business activity, if they exceed the turnover threshold of 1 million dirhams, what are they taxed on? And that's what we refer to as the corporate tax base, as provided by Article 12 of the corporate tax law. So, natural persons are taxed on their income from business or business activities in the UAE, and also their income from the same business activities or business which is outside the UAE. So as long as the business is carried out in the UAE, that is considered part of their taxable base. So if there's operations and business is carried out here, and it operates in several other countries, if it is from these business activities in the UAE, they will form part of the corporate tax base for that natural person. And as per Article 11 of the corporate tax law, Article 11, Clause 3, when a natural person resides in the UAE and they carry out business or business activities, they are considered resident for corporate tax purposes under the domestic law, the domestic corporate tax law that we have in the UAE. Ridha has just mentioned there are instances when there can be a non-resident, and this will follow the relevant double tax agreements. If we have bilateral tax agreements with other countries, individuals who may operate and reside in different countries, they will have to consider those double taxation agreements to see whether they are resident here or whether they are resident in other jurisdictions. But for the domestic law, just to reiterate, if business or business activity is carried out in the UAE, you are considered to be a resident person as a natural person. Exclusions. So Cabinet Decision 49 provides for certain exclusions from considering the turnover figure. So as I've just mentioned, you need to reach, as an individual, reach 1 million dirhams. You need to exceed that threshold to be considered as a taxable person. But there are 3 specific carve-outs to this. The first is salary and wages, the second is personal investment income, and the third is real estate investment income. And what does it mean to have exclusions? Well, if you have income arising from these 3 categories, they are not considered when you're calculating your turnover. You ignore these 3 categories when considering whether you are a taxable person or not. I'll come on to these 3 in slightly more detail on the next slide. But if you are exceeding the 1 million dirham threshold, so let's take this year for example, 2024. If you exceed the 1 million dirham threshold in this year, you will know by the 31st of December this year, or you may know earlier in the year. If that figure is reached, if that threshold is exceeded, you are a taxable person and you have to register for corporate tax. And as His Excellency has mentioned, as my colleague Rida has just mentioned, there is a decision, FTA Decision 3 of 2024, which covers registration. And natural persons, who are resident persons, will have 3 months from the end of the tax period to register. So for 2024, they will have until the 31st of March 2025 to register for corporate tax with the FTA. Individuals who aren't required to register are those who either do not conduct a business or business activity, or they conduct business or business activity, but they do not reach the threshold of 1 million dirhams. Their turnover does not exceed that threshold. The exclusions. As I mentioned, these are covered by Cabinet Decision 49 of 2023. That decision is relevant for natural persons, for individuals. The first category is salary and wages. As an employee, any compensation you receive is excluded. It's carved out from corporate tax. And of course, that has to be a reasonable amount. It has to be subject to the other provisions of the corporate tax law, whether it's at market value, at arm's length. It has to be a fair representation of the services provided. But any money received as a salary, any benefits received under your salary package are carved out. They're outside the scope of corporate tax and they are not considered in the turnover threshold. Secondly, personal investment income. So as an individual, if you hold investments on your personal account, not related to your business, if you hold them on your personal account and you either do not have a license or are not required to have a license, and also any activity you do is not considered a commercial business within the commercial transactions law, then this activity is also carved out. So as a natural person, you may hold passive investment in different companies, whether in the UAE, whether overseas. If you are holding them on a personal account, you are not trading, that is not your business, then this is not considered in your turnover. And this, again, is carved out from corporate tax. The third and final category is real estate investment income. So if you hold land, if you hold real estate, you're renting, subleasing, selling real estate. And the key factor for this exclusion, again, is a license. For these activities, you neither should have a license nor be required to have a license. And if that is the case, any activity will be carved out from the corporate tax law. So if you hold multiple apartments, properties, and you're renting them out, if by the laws in the UAE you are not required to have a license and you do not hold a license, then these will be excluded. The moment you are required, even if you do not have one, if you are required to hold a license, then this will not be excluded. And so for all these three exclusions, if they are not applicable, so if you hold investments for a business purpose or not on your personal account, if you hold real estate and you hold a license, these will be considered when you're calculating your turnover. So let's put this into a couple of examples and walk these through. So we have Mr. A in this example, who is a natural person, and he provides consulting services as an interior designer. In the calendar year, for example, this year, he has income of 800,000 dirhams. He also receives 100,000 of dividends from personal investment holdings that he has on his personal account. He doesn't have a license, and he's not required to have a license for these investments. So Cabinet Decision 49, it's excluded. And he also has a gain on the sale of a personal luxury car. Again, that's excluded. So although the total receipts, the 800,000, the 200,000, the 100,000, total 1.1 million dirhams, the turnover is only, for corporate tax purposes, 800,000. And in this calendar year, he's not exceeded the 1 million dirham threshold. So he will not be considered a taxable person. He will not be subject to corporate tax, and he will not be required to register. Now, I've mentioned licenses a few times when talking about business activity, when you're holding investments, when you have real estate investment. But it's important to know there are certain distinctions between those licenses. So here we have an individual, Mrs. N, who's based in the UAE, and she has a bakery business and also a number of properties. Now from those properties, her receipts, her income is 1.2 million dirhams. But Mrs. N does not have a license for those properties and is not required by law to have licenses for any of those properties. And because of that, they are carved out. As per Cabinet Decision 49, we do not consider them as part of the turnover. So that 1.2 million will not be subject to corporate tax, and neither will it bring Mrs. N into the corporate tax regime. Her bakery business may have a license, but the license is not for the real estate, and that's a distinction to pick up on here. If you have a license, it needs to be related to that activity. For real estate, it must be for real estate. The license must be for real estate. If you have a business license for something completely unrelated, the income from real estate is still carved out. So for Mrs. N here, whilst her real estate income will not be considered and it will be carved out, she will still have to consider the income and the turnover from her bakery business to assess whether she is subject to corporate tax or not. So I mentioned the tax period for natural persons in an earlier slide. For natural persons, the tax period will always be the Gregorian calendar year. So that's the 1st of January to the 31st of December each year. And that means in that year, they will have to consider whether they reach that threshold, they exceed 1 million dirhams of turnover. And if they do, they're a taxable person and they have to register. And I mentioned earlier, they will have 3 months to register, but as we can see on the slide, they will also have a further 6 months, so 9 months in total, to file their corporate tax return and pay any corporate tax due. And one other point to mention, if you are a natural person and in a given calendar year you exceed the threshold, you exceed the 1 million dirhams, you will have to register, you'll have to file a corporate tax return, and you'll have to pay corporate tax. If in a subsequent tax year you do not reach that threshold, for that given year you are not considered a taxable person. So each year is considered individually. Just because you've been brought into the corporate tax regime for 1 year does not mean every period after that, even if your turnover is under 1 million dirhams, you'll be subject to corporate tax. In that case, you will file a nil return. Each calendar year is considered separately. The only exception for tax periods for natural persons is on cessation. If business or business activities as a whole cease, then the tax period will come to an end before the end of the calendar year. And there's more details on that on the natural person guide. We've considered the cessation of business and business activities. And that's the only exception for the tax period being shorter than a calendar year. So that has wrapped up natural persons and summarized the relevant provisions for natural persons. The next section, I'm going to talk about small business relief. And small business relief is applicable to both natural persons and juridical persons also. So what Ridha has mentioned and what we've just gone through together on natural persons, both are considered relevant and eligible for small business relief subject to meeting the requirements. But before we go into the conditions, let's take a step back again. What is small business relief? Why do we have it? Small business relief is found in Article 21 of the Corporate Tax Law and Ministerial Decision 73 of 2023. It's designed to support small businesses, be it natural persons, individuals carrying out businesses, or juridical persons, entities which are smaller. It's designed to support them, and that's why it's in the corporate tax law. It's there to ease their transition into the regime, into the corporate tax regime. We appreciate corporate tax is new in the UAE, the implementation will carry a lot of complexities, and this is intended to give that smaller subset of taxpayers, of taxable persons, that relief for the first few years of corporate tax. And I'll come on to times in just a moment and years when this is applicable. So, what happens if you have small business relief, if you're eligible and you claim small business relief? You are considered to not derive any taxable income. Small business relief means you have zero corporate tax to pay. The other exemptions, which we'll come and cover later on in this presentation, won't be applicable, and they won't be relevant if you are claiming small business relief. By virtue of claiming small business relief, you are considered to have zero taxable income, to have no taxable income. So the other provisions, the other reliefs available will not be applicable. So even if you're in a loss-making position, if you claim small business relief for any reason, you will not have those losses crystallized for yourself. So the key benefits, there's two: administrative relief and tax relief. What is the administrative relief that you receive if you claim small business relief? You will have a simplified tax return. So at the time of filing your corporate tax return, if you are claiming small business relief, there will be a simplified return for you to complete. And also, you are not required to calculate your taxable income. Small business relief considers revenue. You do not need to calculate what your taxable income will be if you are eligible and elect for small business relief. And then secondly, tax relief. Of course, as I've just mentioned, if you are claiming small business relief, you will have no corporate tax to pay. The election itself does not have to be made in the tax period. So following the tax period, you will know what your revenue is for that year. And it's only at the time of filing the return that you make that election for small business relief. So I mentioned there are conditions. So who is eligible for small business relief? Resident persons. So it's both natural persons and juridical persons, but there is a requirement to be a resident person for corporate taxes in the UAE. And that also includes free zone persons. not qualifying free zone persons, and I'll come on to that distinction in just a moment, but any natural person or juridical person, including free zone persons, are eligible for small business relief. What are the conditions? Well, first and foremost, you will be required to make an election in each tax period. So if you apply for small business relief once, that does not mean you will get it every single year, every single tax period. You need to elect for it each year. And the most crucial part, the most important part for small business relief, and this is outlined in Ministerial Decision 73 of 2023, is the revenue amount. The revenue must be equal to 3 million dirhams or lower in the current and previous tax periods. So let's just break that down for a moment. That's a current tax period and previous tax periods. That doesn't consider your revenue before corporate tax was implemented. It's only from your first tax period that we are considering the revenue figure. So for this year, if you exceed the revenue of 3 million, if you have 4 million in revenue, just because your next tax period will be below, you will not be able to claim small business relief. You have to consistently be equal to or less than 3 million dirhams in all tax periods, your current and previous tax periods. If you have under 3 million in this tax period, and then in the following tax period it exceeds 3 million, you will have been able to claim small business relief in the current period, but you will not be able to claim it in the later period because you have exceeded the revenue threshold. And so there's 2 points to note there. First, the revenue threshold of 3 million, but you need to consider for the current and previous tax periods. Small business relief is available for all tax periods from the 1st of June 2023 until the 31st of December 2026. So for natural persons, with their tax period, their first tax period being 2024, the calendar year, this will be the first relevant period for natural persons. For juridical persons, they may have their first tax period which started on the 1st of June 2023. And so that will be eligible, that period will be eligible for small business relief. So who cannot elect? Who is carved out? Who cannot benefit from small business relief? So the first point is qualifying free zone persons. And my colleagues will come on to the distinction between a free zone and a qualifying free zone person in just a moment. But if you are based in a free zone and you either are not eligible for the free zone regime or you opt out of the free zone regime as per the corporate tax law, and your revenue is under 3 million dirhams, you are allowed to benefit from small business relief. So as long as you are not a qualifying free zone person, you can benefit from the regime. As soon as you're a qualifying free zone person, this relief is not applicable to those persons. Secondly, a member of a multinational group. So if a specific entity, if a juridical person is a member of a multinational group which has consolidated group revenue of 3.15 billion dirhams or more in a year, that entity will not be allowed to have small business relief. It will not be eligible for small business relief. And finally, artificial separation. So Ministerial Decision 73 provides for any persons who are trying to artificially separate their business to remain under the threshold of 3 million dirhams will not be eligible for small business relief. So if there's a juridical person and it decides or attempts to separate into two entities, and that is artificial separation, small business relief will not be applicable for that juridical or those juridical persons. So I mentioned in the last slide, revenue is a most important part. Revenue is a critical point that you need to consider for small business relief, whether you are eligible for small business relief. But now we need to know what is in small business, what is in revenue. What do we need to consider for that revenue figure? So the first point is it needs to be on an arm's length basis. What does that mean? Well, Articles 34 to 36 consider related parties, it considers connected persons. If there are any transactions between related parties or connected persons, they need to be on an arm's length basis. They need to either be priced at the market value or aligned with the arm's length standard. Specifically, what will be included? So the first point is quite simple, and I'm sure you'll know, any goods or services provided, they will be considered as part of your revenue figure. Secondly, the sale of any business assets. So if you're a small business and you have some capital assets, you have some items, maybe some plant and machinery, and you dispose of those, even though that will be a capital gain, it will still be considered and it will contribute towards your revenue figure. Thirdly, any exempt income. So if you receive dividends, so Article 22 in the corporate tax law provides and outlines what exempt income is. So if there is any exempt income received, although it may not be taxable, although it will be exempt and will be carved out, it's still considered and contributes to your revenue figure. And finally, any non-cash receipts. So if you receive items, if there's barter transactions, any non-cash receipts, the market value will be considered for those items. So purely just because you're not exchanging in dirhams or in currencies, that does not mean you won't have to consider the revenue threshold. You'll still consider the market value of such items when received. And those four categories that I've just outlined will form part of your revenue. Revenue does not include two categories. So the first is any VAT charged by businesses which is then remitted on to the FTA. In such cases, that will not contribute to your revenue figure. And secondly, any loans or advances received. Again, if you receive a loan, an advance, that will not contribute to your revenue threshold. So to reiterate, the most crucial part of small business relief to consider is the revenue figure. And the revenue figure needs to be considered in line with the relevant accounting standards. So when you're calculating your revenue, you need to consider IFRS or IFRS for SMEs, if using IFRS for SMEs. The Small Business Relief Guide has been released, and it was one of the first to be released, and it does specifically contain some other provisions when you're calculating your revenue. You are also afforded the benefit of being able to use the cash basis of accounting. So again, if you use a cash basis of accounting, you need to consider the relevant accounting standards and recognize your revenue in line with that. So it can either be on the accruals basis or the cash basis. But the most crucial part for considering eligibility for small business relief is making sure that your revenue figure is calculated correctly and whether it is 3 million dirhams or less. So let's work through a couple of examples and put what we've just gone through into action. Here we have company A, who is a resident person, so they may be eligible for small business relief. In a tax period, they have sales of 1.5 million dirhams. So that is a sale, it will contribute and be included in their revenue figure. They also have dividend income of 1 million dirhams from UAE companies. So this here is a juridical person receiving dividends from another juridical person. Article 22 exempts that income. So it won't be taxable, but as we've just mentioned in the last slide, it's considered as part of the revenue figure. So that 1 million is also considered. And then company A has operating expenses of 2 million dirhams. So what does that mean? It means there's a revenue figure of 2.5 million dirhams, the total of the sale of goods or services and the exempt income. And because of the operating expenses, The profits are 500,000 dirhams. Now, operating expenses and profits are not relevant. And that's why this example is here. It's here to highlight that irrespective of your profitability, irrespective of your operating expenses, irrespective of your profit level, small business relief is only concerned with your revenue figure. And here, the revenue figure is below 3 million. It's 3 million or lower. Here it's 2.5 million dirhams. And as such, Company A being a resident person, having revenue of under 3 million dirhams will qualify for small business relief. That has brought us to the end of the small business relief section. So I will now pass on to my colleague Christine, who will talk through some slides on free zone persons. Thank you very much.
Good morning, everyone. Distinguished guests, ladies and gentlemen, tax enthusiasts. So I think this section here has been long awaited. It's on free zones. So what we will be covering in this session here, and it's just going to be a brief session on free zones for now. We will be having very detailed free zone specific sessions and workshops coming up. But what we wanted to do is give you an overview of the recently released free zone guide and some of the details in that. So what I'll be covering is an overview of free zones, the conditions to be a qualifying free zone person, qualifying income, and then going into qualifying activities and excluded activities, the scope of the rules, so the different rates that apply, both to the different business operations that a free zone person may have, as well as the activities, the de minimis requirements, which is definitely a complex calculation, but hopefully once we go through the terms and the different concepts involved in the free zone regime, that'll sort of make it a little bit easier to understand, as well as the taxation of a qualifying free zone person, and then we'll also be going through some specific scenarios for some of the qualifying activities. So to kick off, let me just make sure that's correct. Yep. So at a high level, what is the free zone regime? Really, the free zone regime is allowing the 0% corporate tax rate to apply to certain transactions. So there's generally transactions where a free zone person transacts with another free zone person, and that other free zone person is the beneficial recipient of those goods. It also applies to transactions and activities that are conducted in a free zone or a designated zone. So at a high level, those are the two types of things that the 0% rate applies to. The key thing, and I think the first step is to identify, is whether or not you operate in a free zone or a designated zone for corporate tax purposes. So a lot of you will be already familiar with the concept of a designated zone under the VAT law and also under the excise tax law. For corporate tax, there's a wider sort of range of or scope in terms of what's called for free zone purposes. So you've got the concept of a free zone, and you've also got the concept of a designated zone. And that's a designated zone specifically for corporate tax purposes, and it's considered to be a free zone as well. So in order to be considered a corporate tax designated zone, the first thing that I would say is, let's start off with free zones. For free zones, it's a defined geographic area that's managed by a free zone authority. So that's the first thing you've got to consider. Do you operate in a free zone? And that has to be a free zone for corporate tax purposes. So what we're asking everyone to do is to go and check with your free zone authority whether the particular free zone that you operate in is a free zone for corporate tax purposes. The second thing is designated zones. So there is Cabinet Decision number 59 of 2017 as amended that's published and has a list of all the designated zones for VAT purposes. For corporate tax purposes, the definition of a designated zone means that it's a designated zone both for VAT purposes and it's also a free zone for corporate tax purposes. So each designated zone must be included under both, essentially both lists. It has to be a free zone and it has to be a designated zone for VAT purposes. One of the things I will point out here though is that not all designated zones for VAT purposes are designated zones for corporate tax purposes. So we're asking everyone again to go and check with your free zone authority to determine whether or not the particular free zone or designated zone that you operate in is a designated zone or a free zone for corporate tax purposes. The next thing you need to think about, so if you have a free zone license, you need to see, that means that you're a free zone person. A free zone person is anyone who holds, so is incorporated, established, or otherwise recognized in a free zone. So a free zone person includes free zone authorities, it includes government-controlled entities that are established in a free zone, and it also includes any foreign or UAE juridical persons who have a branch that is licensed in a free zone. There's also the concept of what is a free zone person as a whole. So we go back to the same concepts that we have for VAT. It's all based on being a taxable person. So you're a single individual taxable person. But we know that free zones or entities could have branches. So you could have a branch, for instance, you have a head office entity that's sitting in one of the free zones and a branch that's sitting outside the free zone. So that could be on the mainland or even outside the UAE itself. You could also have the opposites, where you've got a branch that's sitting in the free zone, but a head entity that operates in the mainland UAE or outside the UAE. So those concepts are very important for the free zone rules in terms of identifying what type of entity structure or sort of business structure operationally do you have. It's necessary that you go and identify any of the branches that you do have as part of that one taxable person. So just for ease, what we have done is we have referred, and you'll see that in the guide, the free zone guide that was published, where we have a free zone entity or the free zone operations itself, we refer to that as the free zone parent. And then for all other branches or operations that you have, they are either going to be a domestic permanent establishment. So a domestic permanent establishment is essentially a branch of the free zone entity that's in the mainland UAE, or a foreign permanent establishment. So that's any other part of the business that sits outside of the free zone. And it's really critical to identifying if you have any of those, so if you have a domestic permanent establishment or foreign permanent establishment, because different rules and rates apply to those different operations of a free zone entity or a free zone person. One thing I also will point out here is that because a free zone person has to be a juridical person, it means that the free zone regime doesn't apply to natural persons, it doesn't apply to unincorporated partnerships, and it doesn't apply to sole establishments. So they're all taxed under the normal corporate tax rules. Okay, so we've gone through and we've said that we need to identify our free zone entity or our free zone person, and then the different branches, so your domestic permanent establishment or your foreign permanent establishment. So essentially, the 0% corporate tax rate applies to qualifying income that relates to the activities conducted by the free zone parent entity in the free zone. All other income or revenue generated by a foreign permanent establishment or a domestic permanent establishment are not qualifying income and will not be subject to the 0% rate. So they will all be subject to the 9% rate, the normal rules. So, who here thinks that they're a free zone person? Who's got a license and thinks that they are a free zone person? Okay, so a few of you here. So the next thing is that even if you have a free zone license, the next thing you have to do is understand whether or not you meet all the conditions to be a qualifying free zone person. Because the 0% rate applies to qualifying free zone persons, not just a free zone person. So the first condition that you need to meet is that you have to have adequate substance in the free zone itself, or the designated zone as appropriate. So adequate substance means that you have to have appropriate core income generating activities sitting inside the free zone itself that relate to the qualifying activity or the income that you're generating, that you want to be subject to 0%. So the SIGA, or the core income generating activity, has to be in the free zone or the designated zone itself. You also have to have adequate employees, adequate staff, assets, and incur adequate operational expenses in that free zone for it to be adequate substance. The next condition is that you have to generate qualifying income, and I'll explain what qualifying income is in a little bit, but it's really important that you have qualifying income. Thirdly, you must have not elected to be subject to the normal corporate tax rules. And I'll go into it in a little bit, why you would actually potentially want to elect to be normal to the normal corporate tax rules. Fourthly, you have to maintain transfer pricing documentation or transfer pricing compliance, meet all the compliance requirements around that, as well as maintain adequate transfer pricing documentation for it. So it's really important that all transactions with related parties, a free zone entity needs to make sure that they follow the appropriate arm's length rules in determining the price and maintain documentation for it. A free zone person also has to maintain audited financial statements. So most free zone authorities already need you to maintain that, but it's a requirement and a condition of being a qualifying free zone person that your financial statements are audited. And then finally, you have to meet the de minimis requirements. So the de minimis requirements is really just to allow free zone entities who incur some small incidental non-qualifying income to still not be kicked out of the regime because of that other non-qualifying income. So it's the lower of 5 million dirhams or 5% of your total revenue. And I'll go into that calculation in a lot more detail. Okay, so if you see that you're a qualifying free zone person, you meet all the conditions. Obviously, you'll need to be determining the de minimis calculation at the end of the tax period. But what that means is that all your qualifying income that's derived by the free zone person from the following sources will be subject to the 0% rate. So that's transactions with other free zone persons, as long as that other free zone person is the beneficial recipient of that transaction. So that's, goods and services that you sell to another free zone person. If they're the beneficial recipient, that qualifies. It's also 0% is also applicable to transactions relating to qualifying activities that are not excluded activities, and I'll explain that further in a little bit. It also applies to income generated from qualifying intellectual property. So there's Cabinet Decision 100 and MD 265 of 2023 went into a lot more detail around qualifying income in relation to qualifying intellectual property, and the guide has as well. And then also any other income as long as the de minimis test is met. Now, income that is not subject, so the free zone person can, or the qualifying free zone person can still generate income that is not subject to 0%. So that's everything else that we've categorized separately. So for instance, any income that's attributable to your domestic permanent establishment or your foreign permanent establishment, that is subject to 9%. Any income that is from a movable property located in a free zone that is not a commercial transaction with another free zone person or commercial property with another free zone person, that is also subject to 9%. And then any income from ownership or exploitation of intellectual property that is not qualifying intellectual property will be subject to the 9%. So it's really important that you actually analyze your business, understand all your different revenue streams, as well as who the party that you're transacting with is, in order to determine if that transaction is going to be subject to 0% or 9%. Now, I've mentioned qualifying activities. So here, another really important term to understand for the free zone rules is the concept of a qualifying activity and an excluded activity. So this list is found in the Cabinet Decision issued on that, and there's also further detail there. But the bulk of the information, the details that you're going to get is in the guide, in the free zone guide. But what we're highlighting here is these are the key core sectors that we want to encourage and are subject to the 0% corporate tax rate. But these are all activities that have to be conducted in a free zone or, where relevant, a designated zone. So you've got manufacturing and processing of goods and materials. They're generally very capital intensive operations, and that has to be sitting operationally in a free zone. Trading of qualified commodities in raw form. So with this, Juliana will actually go into a lot more detail, but not all commodities are qualifying commodities. And so she'll explain what the conditions are for it to be a qualifying commodity, but that operation can happen from a free zone. You've also got holding of shares and other securities for investment purposes, ownership and management and operation of ships, reinsurance, fund management, wealth and investment management, services that are subject to regulatory oversight. So those activities conducted in the free zone itself will also be subject to, will also be qualifying activities. headquarter, treasury, and financing services provided to related parties. And so for this purpose, you also may be considered as a related party to yourself. So if you provide those services to yourself, that's also a qualifying activity. Financing and leasing of aircraft, distribution of goods or materials in or from a designated zone. So this is the only activity, qualifying activity, where the concept of a designated zone is relevant for corporate tax. So if you are conducting distribution activities, that activity has to be conducted from a designated zone. So not from a free zone, but a designated zone. And so if you're distributing goods to a customer that resells, processes, or alters such goods or materials or part thereof and then resells those goods, then that's a distribution activity. You've got logistics services. So logistics services is different to distribution services in that you generally, as a logistics provider, you don't have the ownership of the goods. You don't hold the title to the goods. So for logistics services, they actually can be conducted in any of the free zones. So just to stress here, distribution activities are the only ones that need to be conducted from a designated zone. All of these other activities can be conducted from any of the free zones. And then finally, any activities that are ancillary to the above are also qualifying activities. So it's really important to make sure that when we refer to ancillary activities, that activity has to be necessary for the performance of the main activity that you're after. And it makes it doesn't just make a minor contribution to it. So it needs to be as closely related as possible to the actual activity that you're trying to say is the qualifying activity. Okay, so we've gone through qualifying activities. Now there's a specific list of excluded activities. So if it's an excluded activity, it's subject to 9%. So excluded activities generally involve transactions with natural persons, except in relation to a few of the qualifying activities. So that's ownership, management, and operation of ships, fund, wealth, and investment management services, and financing and leasing of aircraft. Banking activities are an excluded activity, so any banks, even if that bank sits in a free zone, it's excluded activity. Insurance activities, except in relation to reinsurance and captive insurance, that forms part of the headquarter services, which was a qualifying activity. Finance and leasing activities are also an excluded activity unless it relates to ownership, management, and operation of ships, treasury and financing services that are provided to related parties, and then financing and leasing of aircrafts. Also, the ownership or exploitation of a movable property that's anywhere except where it relates to commercial property and you're transacting with another free zone, that is an excluded activity. And then finally, again, any activities that are ancillary to those activities are also treated as excluded activities. Okay, so I've gone through a lot of terms, a lot of concepts here. What I wanted to do is just sort of put it on screen here, really how you identify your qualifying income. So what is qualifying income? So essentially, on the left here, we've got any income derived from transactions with another free zone person, and that other free zone person is the beneficial recipient. It's qualifying income. On the right, we have transactions where it's with a non-free zone person. So that could be a natural person, it could be a foreign entity, it could be a mainland entity. But, for instance, in the middle, you've got qualifying activities provided to either a mainland entity or a foreign company. That's qualifying income. And then finally, where you're transacting with, for instance, an individual, and you are providing those categories of qualifying activities, so shipping, fund management, investment and wealth management, and aviation financing and leasing, where you provide that qualifying activity to a natural person, a foreign entity, a mainland entity, it will also be qualifying income. So it's really important that you identify your revenue streams, put them in these buckets to identify what the correct rate that will apply to them is. Okay, I've mentioned de minimis a few times. This is a really important condition to be a qualifying free zone person. So hopefully what we'll do is we'll just break it down a little bit. But the key thing with de minimis is that you can incur or generate, some minor or incidental income that's not a qualifying income. and we will still not kick you out, essentially, of the free zone regime. So the test is that non-qualifying income must be less than 5 million dirhams or 5% of your total revenue. So what that means is, as a business, you need to go and look at your total revenue and then identify what aspects of this calculation your income falls into to determine whether or not you meet the de minimis. So the first thing is, what's your total revenue? Your total revenue is all of the revenue derived by that qualifying free zone person in a tax period. So you have to wait until the end of the tax period to identify that, obviously. The next element is your non-qualifying revenue. So your non-qualifying revenue is any of the revenue generated in the tax period from excluded activities, from transactions with non-free zone persons, and that aren't in relation to qualifying activities, and then finally transactions with a free zone person where they are not the beneficial recipient. So you've got your total non-qualifying revenue here, and then your total revenue. Now, there are certain things that we are excluding from both of those numbers. So the list on the right is certain income streams that are excluded and don't need to be considered for the purposes of your de minimis calculation. So, income attributable to your domestic or your foreign permanent establishment, that doesn't go into your de minimis. It doesn't go into total revenue, it doesn't go into non-qualifying revenue, it's not left, it's not in the calculation because it's subject to 9%. Revenue from transactions in relation to a movable property located in a free zone, other than commercial property transactions with a free zone person, is also not included in these amounts. And then finally, revenue from ownership or exploitation of intellectual property, other than revenue relating to qualifying intellectual property, is also not included in this transaction. So that will again be subject to 9%. So we're not including things that will be subject to 9% based on the rules, the strict application of the rules in the de minimis requirements. So once you've worked out what your non-qualifying revenue is and your total revenue and do the calculation, if you are below the lower of 5 million or 5%, then you have met the de minimis test and you qualify as a qualifying free zone person. However, if your revenue exceeds those thresholds, then you don't meet the condition of being a qualifying free zone person, and unfortunately, or fortunately, you're subject to the normal corporate tax rules. Okay, so this was a diagram we put in the guide, in the free zone guide, and what it does is it actually just brings all the concepts together. We've spoken about domestic or permanent or foreign permanent establishments, immovable property, intellectual property, and then other sources. So it's really important that you have a look at your business and then try to put the revenue streams into these sort of categories here. You know, so for instance, if I take an example of a movable property, we've tried to put a decision tree here which says, okay, if you're dealing with a movable property, is it located outside the free zone? Then that's the treatment there, and whether or not where it goes in your de minimis calculation. If it's located in the free zone, is it commercial property or not? If it's commercial property, then you go to the next step down. Who is the transacting party? If it's another free zone person, then that's qualifying income. If it's not with another free zone person, it's not qualifying income, and it goes into both your total revenue calculation and your non-qualifying revenue calculation. Anything in green actually is included in your total revenue and excluded from non-qualifying revenue. And then finally, anything that's in red is included in your total revenue and your non-qualifying revenue. So hopefully this sort of lays out and brings together all the different concepts and the terms together for free zones and the calculation for de minimis. Okay, so once you've worked out that you're qualifying free zone person, what is the actual tax implications on you? So firstly, you're going to be subject to 0% on your qualifying income and then 9% on all your other taxable income that is not qualifying income. You also won't be eligible to benefit from the 375,000 dirham threshold that applies for other taxable persons, where that first 375,000 of taxable income is subject to 0%. For everything that's not subject, so everything that's not qualifying income that's is subject to 0%, that'll be your taxable income that is not qualifying income. And that taxable income needs to be calculated according to the standard rules under Article 20 of the Corporate Tax Law. However, because you're a qualifying free zone person, you don't get the benefit of certain reliefs. So for instance, you're not eligible, as Zubair mentioned, to benefit from small business relief, qualifying group relief, business restructuring relief, transfers of tax losses, or be part of a tax group. Those are actually some of the reasons why you may, as a free zone person, want to elect to be subject to the normal corporate tax rules. So, under Article 19 of the Corporate Tax Law, you're able to elect to be subject to the normal corporate tax rules and then be able to enjoy the benefits of all those other reliefs that are under the Corporate Tax Law. If you do elect to be subject to the normal corporate tax rules, that election is effective from that tax period or the following tax period and the subsequent 4 tax periods. Another way that you can lose your status as a qualifying free zone person is if you do not meet the conditions. So we went through the 6 conditions of being a qualifying free zone person. If at any point during a tax period you don't meet those conditions, then you cease to be a qualifying free zone person, effective from that tax period and also the subsequent 4 tax periods. There's also the administrative requirements for a qualifying free zone person. So you still absolutely do need to register with the FTA for corporate tax. You still need to file a tax return. You still need to comply with transfer pricing rules and documentation requirements. And you need to prepare and maintain audited financial statements. So that sort of recaps, I guess, the benefits and the obligations specifically for qualifying free zone persons. I'll just quickly go through an example here of how that sort of plays out. So we've got ABC FZ code that's established in Jebel Ali Free Zone, so it's a designated zone for corporate tax purposes, which makes it a free zone. So they meet all the conditions. They've done their analysis, it's at the end of the tax period, they've gone through and they've checked everything. They have adequate substance in the free zone or in the designated zone. They prepare audited financial statements, they comply with transfer pricing requirements and maintain documentation, and they haven't made the election to be subject to the normal corporate tax rules, so they meet all the conditions. The last step in terms of the conditions is the de minimis, which can only be determined at the end of the period. So what they do is they go and they do the calculation. They look through all their revenue streams, put everything in its appropriate buckets, and work out that they have received revenue from distributions of goods and and materials from the designated zone that they operate in, and they sell that to non-free zone persons. They've made 8.5 million dirhams of sales of distribution goods to non-free zone persons. They've also generated revenue from distribution of goods and materials to natural persons who are the end customers. So they made 350,000 dirhams of revenue from transactions with natural persons in relation to distribution. So what they need to do is then do the de minimis calculation. So their total revenue is 8.85 million dirhams, and of that though, 350,000 dirhams is non-qualifying revenue. So what they would do is do the calculation, and for them it works out to be 3.95% of their total revenue relate to non-qualifying revenue. The 3.95 or the 350,000, both of those are below the de minimis threshold. So the lower of the 5 million or the 5% of total revenue. So they actually do meet the de minimis requirements. They qualify as a qualifying free zone person, they've met all the conditions, and their qualifying income as well as the 350,000. So the total revenue that they generate will all be qualifying income. Okay, so I've sort of gone over the theory behind it, the terms and concepts. Juliana will now go through some very specific scenarios and some more detail about the qualifying activities and qualifying income.
Good morning, everyone, Your Excellencies, ladies and gentlemen. So now that Christine went through this overview on the free zone regime, and we understand it's a lot of new concepts, and also the ministerial decision 265 listed exactly what are the sectors that are considered as qualifying activities for the purpose of the free zone regime. So now, since the guide has been published recently, we already received quite some feedback and some of the areas and some of the specific qualifying activities that free zone persons are interested in receiving some more clearance. So that's why we selected a few examples. And now I'm going to guide you through some of the qualifying activities and how the rule applies to these qualifying activities. So the first selected qualifying activity that we want to give you more detail, it's about the distribution of goods or materials in or from a designated zone. And as Christine precised, in the case of the distribution sector, we have this specificity that we consider what is a designated zone. So for the purpose of distribution activities, we need to be involved and be based in a designated zone for the purpose of corporate taxes. When we are talking about distribution activities, we are typically referring to the process of transporting products from a manufacturer, storing them, and selling them to resellers. So here it's really important to bear in mind that we are talking about resellers. So this is a distinction from an end user. So when we are talking about distribution activities, we are always taking into consideration that we are talking about a reseller, which means someone that will resell or process these goods for reselling. We're not talking about cases where you are the end user of the goods or products. Another important point is that the distribution activity can involve different types of transactions. We can talk about the buy and selling of goods for reselling purpose. We can talk about importation, inventory management, warehousing. So all these sets of activities that are related to the distribution sector. And a key important factor is also that when we're talking about distribution, we are talking about holding the title of these goods and materials. So always when we are considering your activity, you have to analyze whether you are the distributor and whether you are holding the title of these goods or materials. And another important factor mentioned by Christine is that when we are talking about distribution, we are talking about a designated zone. And in this case, you can have different types of transactions, and I go you through a few examples. But in the case the goods or materials, they enter the UAE for distribution, they must be imported through a designated zone. And in the case also another scenario where the goods are already present in the UAE or they are produced in the UAE, they not necessarily to physically pass through this designated zone, but the distribution activity must be performed in this designated zone. And when we're talking about reseller, we are talking about the person that resells such goods or materials, or they are processing those materials with the purpose of reselling at a later stage. So just to give you a quick example, we could have the case of a consulting company that purchases laptops for the employees. In this case, the consultant company is the end user of these laptops, so this wouldn't be considered as a distribution activity. Whereas if we're talking about an electronic retail outlet that buys these laptops and then resells to other shops or to other business, then we can consider this as a case of distribution and therefore can be considered as a qualifying activities for the purpose of the free zone regime. So here, the first scenario that is quite common in the UAE is the case of distribution of goods or materials outside the UAE. So in this case of what we call commonly as high sea sales or third port trading, here, as you can see in this diagram, we have our LLC, which is located in a designated zone in the UAE, that purchases goods and pays for such goods that are manufactured in country A. and the goods are directly shipped from country A to country B, to a retail located in country B. So as you can see, the LLC is located in the designated zone, and they make the process of buying and selling those goods and making all the sorts of arrangements related to the distribution activity. But the goods are not shipped, and they do not enter the designated zone. But in this case, still this transaction is considered as a qualifying activity, and therefore the sales profit, in the case that this RLLC meets all the other conditions to be considered as a qualifying free zone person, they can benefit from the zero rate. Another scenario commonly seen is the case of imports of goods and materials. Here, the difference from the case of high C sales is that this free zone person, or LLC, that is also located in a designated zone, they buy the goods from a manufacturer in country A, they pay for such goods, the goods are delivered in the designated zone in the UAE, and afterwards this OLLC finds retailers in the UAE. But here, as you can see, the goods are delivered in the designated zone, and they are imported and then distributed from the designated zone. So as you can see, in this case, the goods pass through the designated zone, and therefore they are also considered as a qualifying activity, and all the sale profit can be considered as a qualifying income subject to a 0% corporate tax rate. Here we have another scenario of the distribution sector. We are talking about the export of goods or materials. In this case, we have a PLLC that is located in a designated zone, and they are buying these goods from a manufacturer that is located in the UAE, and then they are making the transactions and selling these goods to a retailer that is located in country C. So as you can see, the designated zone person, they are buying the goods from a manufacturer in the UAE, but the goods are directly shipped from the manufacturer to the retailer in country C. So the goods in this case, they don't pass through the designated zone, but the free zone person handling the distribution is located in the designated zone. So in this case, this is another possibility where you have a qualifying activity in the distribution sector, and the sales profit, provided that you meet all the other relevant conditions of being a qualifying free zone person, will benefit from the 0% corporate tax rate. And another scenario relevant to the distribution sector, here we are talking about a distribution within the UAE. In this case, we have a HLLC that is also located in a designated zone, but in this case, they are buying the goods from a manufacturer in the UAE and selling to a retailer also located in the UAE. So in this case, the goods are shipped directly from the manufacturer in the UAE to a reseller also located in the UAE without the need to pass through the designated zone, because the goods were already located in the UAE, and the free zone person is located in the designated zone. So it's entitled to manage this transaction and to buy goods from a manufacturer in the UAE, sell to a retailer also located in the UAE, and benefit from the qualifying activity conditions. Another qualifying activity that we notice taxpayers are very interested in understand better, it's the case of qualifying commodities. So in the case of qualifying commodities, we received a number of private clarifications asking precisely what we mean by qualifying commodities, which products can be considered as a qualifying commodity for the purpose of the free zone regime. So first of all, it's important to bear in mind we are talking about metals, minerals, energy, and agricultural commodities. And these commodities need to be in what we call a raw form. And also, they must be traded on a recognized commodities exchange market. When we're talking about raw form, we are talking about natural unprocessed state close to the form where these commodities were harvested or extracted from the nature. We are talking about cases also, there could be possibility of doing a minor processing to meet the exchange market standards. So for instance, when coffee beans are traded or gold is traded, even though it's a natural product, it requires certain processing in order to be able to be exchanged, to be sold in the trade market. So this doesn't mean we are changing from its raw form. And one indication we can give to business in order for them to assess whether you are still maintaining the raw form is through the HSN code. So normally if there is a big processing, there could be the cases where the code has changed, but here just the fact that the HSN code has changed not necessarily means that this commodity has changed and has lost its raw form. Here we highly recommend you to do the technical analysis to see if this change in the raw format means a minimal processing or not. And as I mentioned, the third condition in order to be considered as a qualifying commodity is that these commodities can be exchanged in the recognized commodities exchange market. So here we are talking about commodities exchange market widely known, either if they are established in the UAE or abroad. So for example, the Dubai Gold and Commodities Exchange, London Metal Exchange, DEFSA, and other exchanges markets that are recognized to the public. And in these cases, when we're talking about qualifying commodities, what we are covering the physical trading, so which means buying and selling of qualifying commodities, and as well as the trading of associated derivatives used to hedge risks related to those activities. And also the ancillary activities that are closely related to this business of trading qualifying commodities. And here, just an important point to note, we do not necessarily mean that you need to perform an actual exchange in order to be considered as qualifying commodity. So not necessarily you need to be buying and selling gold, but then you have to be making business with this commodity that is subject to trade. And here to give you a practical example of trading of qualifying commodities that we saw in practice, we have the case of our LLC, which is a free zone person that trades cotton bales. And during a certain year, our LLC sells cotton bales to another LLC company. And in this case, the cotton is harvested and ginned to remove seeds and then compressed into bales. So as you can see, this material suffered some software transformation, but in this case, for the purpose of the free zone regime, this is considered just a minimum process, which is natural in the context of exchanging qualifying commodities, and it doesn't change the raw form of the material. So in this case, it can be considered as a qualifying commodity, and therefore this transaction between RLLC and OLLC will be considered as a qualifying activity, and the profit from the sale transaction will be subject to 0 corporate income tax rate. Whereas here we have a second scenario of PLLC, which is also a free trade person that trades cotton fabric. And in this case, PLLC sells cotton fabric to CLLC. And in this case, we are talking about cotton fabric. So the cotton bales, they have been processed in order to be turned into cotton fabric that will be used to making clothes and other textiles. So as you can see here, the cotton has significantly been processed and has been transformed into cotton fabric. So in this case, it has lost its raw form, and therefore it's not considered anymore as a qualifying commodities for the purpose of the preferential regime. So in this case, this won't be considered as a qualifying commodity, and the transaction between P and C LLC won't be considered as a qualifying activity. Moving next, another scenario that we found, we received a number of queries, is when we're talking about immovable and commercial property and free zone persons. So here, I just want to give you more details what is considered as an immovable property for the purpose of the qualifying free zone persons. When we're talking about immovable property, we are talking about any area of land or plot over which rights and interests and service can be created. So here we are talking about any building, structure, or engineering work that is attached permanently to the land or to the seabed. This can be also any fixture or equipment which makes up a permanent part of the land and is permanently attached to a building, to a structure, or to an engineering work. And also, yes, it also something that is considered as settled and fixed in a space and cannot be moved without deterioration or alteration of its shape. So this is what is considered as immovable properties for the purpose of the free zone rules. And when we are talking about commercial property, we are talking about immovable property or part thereof that is exclusively handled for the purpose of a business or business activity. So when we're talking about commercial property, we're saying that the immovable property cannot be used to be a place of residence or accommodation, which means hotels, motels, bed and breakfasts, and service apartments are not considered as commercial properties because, yeah, you cannot have a residence purpose. And here I just wanted to guide you through a few different scenarios that we addressed more in detail in the Free Zones Guide, but it's helpful to visualize that when we are talking about a commercial property located in a free zone, all the income from transactions with a free zone person, who is the beneficial recipient of the income, will be considered as a qualifying income. And as we know, when it's considered qualifying income, the profit will be subject to a 0% corporate tax rate. Whereas if we have a case of a commercial property also located in a free zone, but the difference here in the second scenario is that we are talking about transactions with a free zone person that is not the beneficial recipient. So as you can see, the fact that the free zone person is not the beneficial recipient changes the tax treatment, and in this case, the income will be considered as not qualifying income and will be treated as taxable income subject to the standard 9% corporate tax rate. A third scenario that is possible, it's the case of other immovable property in a free zone. So in this case, other immovable property, we are talking about any property that it doesn't have a commercial purpose. So in this case, since it's not meeting the condition of a commercial purpose, it will be considered as not qualifying income, and here again will be treated as taxable income subject to 9% standard corporate tax rate. And a fourth scenario that is possible, it's the cases where we are talking about immovable property that is located outside the free zone. So if a free zone person is receiving income from any movable property, including commercial, that is located outside the free zone premises, then this income will be considered as not qualifying income and will be treated as an excluded activity because, yeah, in Ministerial Decision 265, this is listed as one of the scenarios that Christine mentioned before of excluded activities. And if it's excluded activity, it will be considered as non-qualifying revenue, unless it's attributable to a domestic or foreign permanent establishment. And here, just to mention you, there can be some possibilities that we are talking about a property that has mixed use that is located in a free zone. In this case of mixed-use property, the income shall be subject to either a 0% corporate tax or a standard 9% corporate tax based on the use of the property, or in this case, the relevant part. So the commercial portion of the property, for instance, if you have an entire building and some of the floors are dedicated entirely to office rental space, this office space will be subject to 0% corporate tax. Whereas the non-commercial portion, so if you have certain floors that are dedicated to residences or to accommodations, unities, or conference rooms, this part of the building will be subject to corporate tax at 9%. And in these cases, when you are calculating the taxable income due, you have to make use of a direct allocation method if possible. But if it's not possible a direct allocation, the indirect allocation method will be based on specific market conditions, and property characteristics may be used to determine the allocation in this case. This could be, for example, based on the relevant land register department or based on the rental or property value, and then you would have to calculate an arm's length allocation that is reasonable based on the facts and circumstances of the case, based on the exact area. And just to wrap up, I would like to show you an example of mixed-use property based on a real scenario we have analyzed. So here we have a RLLC, which is a free zone person that has a 10-floor building located in a free zone. This building has 8 floors that are used as residential apartments, so in this case, the non-commercial usage, and 2 floors, so 20% of the property used as retail space, occupied by other free zone persons. So in this case, the free zone persons receive an annual rental income total of 10 million dirhams from the entire building. But as we just saw, we would need to make the direct allocation of the income received from rental. And using the direct allocation method, ideally, you would reach that the income derived from residential apartments, it's the equivalent to 80% of the rental income received, which is 8 million dirhams. And therefore, these 8 million dirhams will be subject to 9% corporate tax rate. Whereas the income that is related to the commercial use of the property, which is 20% of the rental income, 2 million dirhams, will be considered as a qualifying income, and therefore will be subject to corporate tax at 0%. So I hope you'll find these different scenarios useful, and we'll resume after the break. Thank you. I'll give the word to Rita.
Thank you so much to our experts. Before leaving the hall, we just wanted to let you know and clarify that the authority has allocated an information desk outside the hall by the registration. You can pass by, and they'll be more than willing to answer your inquiries and assist you. See you back after a bit. Thank you. Ladies and gentlemen, we hope you had a refreshing break. We now move to the second part of our workshop for today. We'd like to welcome back Rida Hamzawi, Christine Awad, Juliana Candido, and Zubair Chowdhury as they continue their presentation.
Thank you, Your Excellencies. The coffee break is over, I think, so, okay. So for the next, I think, part, we will talk about key aspects on the determination of taxable income or the computation of taxable income. And I think this slide just summarizes the key steps in how to reach or how to determine the taxable income. Of course, our starting point is always the accounting income as, per the accounting standards applicable in the UAE. And then we need to make some adjustment in respect of unrealized gain or losses if an election is made by the taxable person. And then we need to also add or deduct some, exempt income or exempt losses. Then we need to consider various reliefs available under the corporate tax law, and I think my colleague Zubair will talk about the reliefs, like the business restructuring relief, the transfer within qualifying groups, and also the transfer of tax losses to member of a qualifying group. We will talk about also about deductible and non-deductible expenditure. We need also to conduct a transfer pricing adjustment in order to consider any non-arm's length, payment or deductible expenses made by the taxpayer. Also, we need to consider specific adjustments that are provided under Ministerial Decision 134. Then at this point, we determine the taxable income before the tax loss relief. We, take into consideration the losses carried forward up to the limit applicable under the corporate tax law, which is 75%. And then we have the taxable income. We apply the tax rates. And of course, in the case of a qualifying free zone person, the tax rates will be 0% on qualifying income, on all the qualifying income, and 9% on the all the taxable income without applying the 0%, the exempt band up to 375,000 UAE dirham. And then we determine the corporate tax liability, and if there is any credit for withholding tax or specifically for foreign taxes, we can claim this foreign tax credit as applicable per Article 47 of the Corporate Tax Law, and I think we have a slide on foreign tax credit. So I think this slide is very good because it summarizes the various steps on how to determine the taxable income starting from the accounting income. Basically, realization basis is an option under the is an election under the corporate tax law, and realized gains are or losses are gains or losses that occur on the completion of a specific transaction, the transfer usually of an assets or a transfer of a liability. Unrealized gains or losses, they relate to a notional variation in the value of an asset or liability without a real transaction, so without an actual disposal or transfer, basically the the variation is usually reflected into the financial statement when the accrual method is adopted. So a taxable person, if he's following the accrual basis of accounting, he can elect to consider gain and losses only on realization basis when calculating his taxable income. And he has two options, either to choose this for all the assets and liability which are subject to fair value or impairment accounting, or only to assets that are classified as capital assets. And of course, this election allows to give relief in terms of treasury, because if there is an appreciation of certain assets, if you elect for the realization basis, you will be given a relief because you will not pay CT on a gain that is not realized yet, and where of course, you will be able to get a relief in terms of treasury, so you will not pay any tax on gains that has not been effectively realized. The election for the realization basis, it needs to be made in the first tax period at the time of filing the first tax return, and as per the provision of the CT legislation, it is an irrevocable election. Let's take an example. If company Z acquires a building from a third party for 800,000 at the end of tax period 1, and it records the building for its net book value of 800,000. If in tax period 2, company Z revalue the building for 960,000, and of course there is a variation in the value of 160,000, which is reflected in the accounting income, and of course this is considered as an unrealized gain. In tax period 2, company Z will depreciate the assets based on the straight line method over a period of 10 years, and the depreciation, the annual depreciation will be 96,000. Assuming that company Z does not make an election, then in that case, of course, company, would be subject to the tax on the unrealized gain of 160,000, and it will pay tax, of course, for this. And in that case, of course, the requirement is to make an adjustment for the depreciation. If an election is made, in that case, the 160,000 basically will not be considered for the determination of taxable income. Also, in year 2, we need to make an adjustment for the entire depreciation, because in that case, the depreciation should not be deductible. The 96,000 in year 2 should not be deductible because it relates to a change in the net book value that exceeds the original cost of the assets of the building. So basically, the election for realization basis, if it's done in the first tax period, it should be applicable to all assets, and according to which type of assets you elect for. So basically, and then of course, if you do it for the first year, it's going to apply across the board for all the future tax period, and the election needs to be done when filing your corporate tax return. Exempt income, so there are various types of exempt income under the corporate tax law. Basically, exempt income are, detailed under Article 22, Article 23, 24, and 25. So, Article 22 and 23, they are talking about the exemption of dividends and also the participation exemption. Article 24 is talking about the foreign PE exemption. Article 25 on the is talking about the income from international shipping and transport of non-resident companies. Here we're going to focus on the participation exemption and also on the exemption of dividends. So basically, dividend received from a UI company, they will be exempt from corporate tax irrespective of any condition. And of course, the dividends, it needs to be paid by a company that is a resident for corporate tax purposes. If you receive a dividend from a foreign entity, the dividend will be exempt from corporate tax provided it meets certain conditions, and the conditions are the participation exemption requirement as listed by Article 23, Clause 2. So basically, the participating interest, so the participation, it should meet mainly a requirement of 5% or higher in terms of ownership interest, and also it should be held for or intended to be held for an uninterrupted period of 12 months. And of course, we can benefit from the participation exemption if we don't have a 5% ownership or higher of 5%, if we have an historical cost of acquisition of 4 million. But if we have a 4 million in terms of historical cost of acquisition, all the other conditions still are applicable. So the historical cost of acquisition of 4 million, it is applicable. It would replace only the 5% ownership requirement. And then if the participation exemption conditions are met, Basically, these types of income will be exempt from tax. So basically dividends, other profit distribution, capital gains on shares, foreign exchange gains, and also impairment gains. And of course, all of this applies equally to gains and losses. So if you have also a capital gain loss on a transfer of shares of a participating interest, also in that case, the loss will not be deductible to consider the symmetry between gains and losses. The provision related to exempt income, they do not apply, of course, if the small business relief election is made, because I think of course, in that case, the person would benefit from an exemption under the small business relief, or he will be deemed not to realize any taxable income under the small business relief rules. So in a domestic situation, of course, if parent company has a participation of 10% in participation co, and the participation co distributes the dividends to parent co, in that case, as we said, because we are in a pure domestic situation, the dividends paid by participation co to parent co, it will be exempt irrespective of any condition. The only requirement is that participating co should be a resident person for corporate tax purposes. And then if still we have a domestic scenario, so two resident companies, and parent co owns 10% or more of in the share capital of participation co, if parent co will sell the shares, part of or some of the shares of participation co, in that case, the capital gains, they will be exempt from corporate tax only if the participation exemption requirements are met. So 5% ownership, holding the participation for at least 12 months, and all the other requirements, so participation co should also be subject to tax, and all the other requirements that are mentioned under Article 23(2) of the corporate tax law. So in a pure domestic situation, for dividends, we have always an exemption, and for capital gains, we have also an exemption subject to meeting the participation exemption requirement. Now, in a cross-border scenario, if we have a foreign subsidiary or a foreign participating interest, so parent co is a UAE company and owns 10% of participation co, which is incorporated or resident in a foreign country, whether for dividends or for capital gains, the participation exemption requirements, they need to be met if we would like to benefit from an exemption on those dividends and those capital gains. So basically, the participation exemption requirement, they would apply for domestic capital gains. They will apply also for foreign dividends and also for foreign capital gains. Domestic dividends, they will be always exempt from corporate tax if the distribution is done by a resident company, and this is based on Article 22 of 1 of the corporate tax law. So if we take an example, Company A is resident in UAE. It holds 20% ownership interest in Company B, which is a foreign entity. Company A receives dividends and interest income on a loan provided to Company B, in addition to realizing capital gains from the sale of a small percentage or small number of shares. So here, what is the types of income that will be exempt if the participation exemption requirements are met are typically the dividends and the capital gains from the disposal of the shares or the interest in Company B. Other types of income, they will not benefit from the participation exemption. So the interest income on the loan, it will not be eligible for the participation exemption. So the interest income will be subject to corporate tax in the UAE. So the interest paid by company B to company A will be subject to corporate tax. The dividends and the capital gains, they will be exempt if the participation exemption is requirement is met. One of the other condition of the participation exemption is also that company B is subject to corporate tax in the foreign country at a rate that is equivalent to, at least at a rate that is equivalent to the UAE corporate tax rate, which is 9% or higher. But even if company B is subject to a nominal rate that is lower than 9%, if the effective tax rate of company B is equal to or higher than 9%, we will consider that the subject to tax requirement is met. And this is something that is clarified also by Ministerial Decision 116 on participation exemption. Also, in terms of structuring, if the dividend that is paid by company B to company A is perceived or is treated as a deductible payment according to the domestic tax law of company B, then in that case, even if the UAE look at that payment as a dividend, because of the fact that it is deductible in country B, it will not be considered as eligible for the participation exemption. And this is also a requirement that is provided under Article 23, 5 or 6 of the corporate tax law. So basically, if the dividend that is paid by company B to company A is perceived as a deductible payment, for example, as an interest in country B at the level of company B, then in that case, in order to avoid the double benefit, so a deduction in company B and then an exemption in company A, the participation exemption will not be applicable. And of course, this is also quite detailed in the participation exemption guide. This is why it's extremely important to go through all the guides and to read all the examples in the guides. So what about deductions and deductible expenses? So there is a general rule on deductibility of expenses incurred for corporate tax purposes. So basically, expenses, they need to be incurred exclusively for business purposes. And if they are incurred for more than one purpose, the part or the portion that is deductible is only the one that is incurred for business purposes. So what is not deductible? Any expense that is not incurred for business purposes, that is capital in nature, because all the expenses that are capitalized, they will get another form of relief, which is in the form of kind of depreciation. And then also expenses that are incurred in deriving exempt income, and also losses that are not connected or arising out of a business. Now, what about interest expenses? So interest expenses that are subject to a specific rule, which is the general interest deduction rule. But of course, the general rule is always deductible. The general rule on deductibility of expenses is always applicable across the board to all the expenses. Now, the specific rule applicable to interest expenses, basically, it provides that the interest expenses, they should be subject to a cap in terms of deductibility, which is 30% of EBITDA. And this is something derived from the one of the OECD report on the deductibility of financial expenses and similar expenses. And if this cap is applicable if the net interest expenditure exceeds 12 million dirham in a tax period. So the general interest deduction limitation rule is not applicable to banks, to insurance providers, and also to natural persons that are considered as taxable person. Entertainment expenses, 50% of them are deductible and 50% is considered as non-deductible, and I think this is related to meals, accommodation, and transportation. Donation, gifts, so donation paid to qualifying public benefit entities are considered as deductible. Other donation, so donation made to other person, they will not be deductible for corporate tax purposes. And the list of qualifying public benefit entities, it has been published by Cabinet Decision number 37 of 2023, and we understand that this Cabinet decision is meant to be updated from time to time. So fine and penalties, basically, those incurred as a compensation or a damage for a breach of contract, they will be considered as deductible. Other fines or penalties for infraction of the law, they will not be deductible. Bribes, illicit payments, they are not deductible. Dividends and other profit distribution, they are not deductible. Amounts that are withdrawn from a business by a natural person or by a partner in an unincorporated partnership, they are not deductible. Corporate tax is also itself is not deductible. And input VAT is not deductible if it's recoverable as an, as an input tax. If it's not, if it's irrecoverable, it could be deducted for corporate tax purposes. And of course, we cannot accept the deduction of, any expenses for the period where the small business relief election is made, because you are deemed in that period to, as explained by Zubair, you are deemed not to realize any taxable income. So the general interest deduction limitation rules, basically, for the purpose of applying this rule, we need to define a few concepts. The first one is the net interest expenditure. So the net interest expenditure is the deductible interest, which is the difference between the interest expenditure incurred, including any carried forward net interest expense, and the interest income derived during a taxable period. So basically, the difference between what you incur as interest and what you get as interest. And then this will be deductible if it is subject to the greater of 30% of EBITDA or 12 million. The exception to this rule is that the general interest deduction limitation rule, it would not be applicable if the net interest expense is below 12 million for a specific tax period. Of course, if it will not apply to specific businesses, the banking sector, because this is the essence of their activity, to insurance providers, and also to natural person. And of course, to consider some specific activities which are heavily capitalized and which are incurring a large amount of interest expenditure. Also, resident person who facilitate maintenance or operation of qualifying infrastructure project, they will not be subject to this rule. Also, financing arrangement that are dated, prior to 9 December 2022, which is the date of the release of the corporate tax law, will not be subject to this rule. There are also specific, interest limitation rules for certain types of income or certain types of transactions. So basically, no deduction of interest expenditure would be allowed for interest incurred on loan obtained from the related party, where the purpose of the transaction is to finance dividends or profits distribution, to redeem or repurchase share capital, to make a capital contribution, or to acquire also an ownership interest. So let's take an example on the interest limitation rule. For example, if in financial year 2025, company C has the following financial features. So a revenue, gross revenue of 150 million, an adjusted EBITDA of 130 million, a profit before tax of 80 million, interest expenditure of 80 million, interest income of 30 million, and net, of course, in that case, the net interest expenditure is 50 million, which is 80 minus 30. In that situation, company C may deduct its net interest expenditure of 50 million up to the greater of 30% of its EBITDA or the minimum of 12 million. So 30% of the EBITDA is 39 million. So this is above the, 12 million, and hence, of course, the maximum, hence, the maximum deductible net interest in that case is possible for 2025. Company C total net expenditure in 2025 is 50 million, and then if you deduct the 39 million in this tax period, the remaining, which is 11 million, it could be carried forward for the next tax period for up to 10 years. So if you are not able to deduct your net interest expenditure for a specific tax period because of the maximum of the cap established by the 30% of the EBITDA rule, then in that case, the difference could be taken and carried forward to the next 10 tax period. And this is also, it's a big advantage under the corporate tax law. It's a big relief in order to allow for the deductibility of interest over a certain period of time, which is, I think, 10 tax period, which is quite generous. Few words on transfer pricing. So I think the FTA published a comprehensive guide on transfer pricing rules. Basically, transfer pricing are all the rules that are related to how to price the transaction between related parties. The TP rules, the main purpose is to ensure that the price of a transaction is not affected by the relation between the related party. Basically, based on the transfer pricing rules, the FTA will be able to review and adjust all the transaction between related parties and make sure that they meet the arm's length principle. Also, the corporate tax rules, they allow for what we refer to as a corresponding adjustment made if you have an adjustment to a related party, or if you are subject to transfer pricing adjustment, the FTA will, of course, adjust systematically the taxable income of your related party, and this provision is meant to, achieve, or allow to avoid economic double taxation. So, if I am subject to transfer pricing for a transaction between a company A and company B, both companies are resident companies, and the FTA thinks, or the tax authority thinks that I understated my income, then the FTA can increase the taxable income. But of course, on the other side, this should trigger a reduction of a taxable income of the related party. And this is, of course, in a domestic scenario. If we are in a cross-border scenario, it is possible always to ask for, apply for a corresponding adjustment. So if you are a UAE resident company, you have a client in a foreign country and you charge that client for a specific price for a transaction. And of course, this client is a related party. If the tax authority in the foreign country would reassess and redetermine the pricing of that transaction and consider that the pricing of that transaction has been exaggerated, and would try to reduce the price to reduce deductibility of at the level of the foreign tax base, then in that case, the taxpayer in the UAE that was part of that transaction, he can apply for a corresponding adjustment, and we say corresponding adjustment just because it should correspond to the adjustment that took place in the foreign jurisdiction. So in a domestic scenario, this is happening systematically by the FTA. In a cross-border scenario, it is based on an application that is happening by the related party that is based in the UAE, and then FTA, of course, will check and process this and approved if the requirements are met. And the same rules between brackets is available also under double taxation agreement. All tax treaty, they include this rule under Article 9, Clause 2 related to associated enterprises. So this rule that we have under domestic tax law also is also a reflection of, also exists in almost all the applicable UAE tax treaties. Businesses, that, of course, that elect for the small business relief, they are not required to comply with transfer pricing documentation. However, they need to comply with the arm's length principle, and maybe something also, I think it was mentioned also by Zubair, the 3 million threshold for the sake of the small business relief, it's an arm's length threshold. So this threshold, it should be determined, should be assessed on an arm's length basis. So if, for example, a taxable person elected for a small business relief for a specific year, and then, after like few years, the FTA consider that, for example, certain number of transactions of that taxpayer were conducted with a related party, and that the price was reduced, and it does not reflect the arm's length price, the FTA would be able to reassess this, and of course, because of the reassessment, he will exceed the 3 million in terms of revenue. The person will not be eligible anymore for the small business relief. So and I think this is a point that was mentioned also in the small business relief guide that was published almost, I think, a year ago. The small business relief threshold is an arm's length threshold. So the 3 million is it should reflect an arm's length revenue. So for transfer pricing, of course, we have a definition of related parties. We have also a definition of connected person. Maybe it's good to mention that for connected person, the definition does cover directors or officers. It does cover also natural person who directly or indirectly, they have ownership interest in the taxable person. And then all the payment or benefit between those connected person and the taxable person, they should correspond to a market value. And of course, they should be incurred wholly and exclusively for business purposes, including for wages and salaries. So if a director is the owner of the company and he's at the same time an owner of the company, the salary that he gets, he should be an arm's length salary, because he's considered as a connected person according to the Article 36 of the Corporate Tax Law, and then any transaction including payment of salary should reflect an arm's length value. And of course, we have the definition of also related parties, and for the related parties definition, we should also note that one juridical person and permanent establishment, they should be considered as related parties, whether in, of course, in a domestic scenario, so between a head office and a branch, or also in a cross-border scenario between a UAE head office and a foreign permanent establishment, or vice versa, between a foreign head office and a branch or a permanent establishment in the UAE. And I believe also that it is worth to note that this definition of related parties is very consistent with what is also applied across the board in most of the jurisdiction in the world having transfer pricing legislation or transfer pricing rules. So the foreign tax credit is a very important provision of the corporate tax law. It is reflected in Article 47 of the corporate tax law. So basically, This allows or gives entitlement to a tax credit that could be deducted from the corporate tax liability with respect to taxes paid by the taxpayer in foreign jurisdiction. So of course, in order to be eligible for the foreign tax credit, you need to pay taxes in a foreign country on foreign source income. And this tax, as it is mentioned here, it could be used to offset the corporate tax payable in the UAE for the same tax period. So the amount of the foreign tax credit, it cannot exceed the corporate tax due on the foreign source income. And the foreign tax credit, of course, it cannot be carried forward or carried back, and no refund is given for foreign tax credit. So you need to use the foreign tax credit in the year in which the foreign source income is taxable in the UAE. Of course, in order to claim the foreign tax credit, you need to provide the documentation supporting or evidence supporting that you paid taxes in the foreign country. Very important point is how to compute the foreign tax credit. So the amount of the foreign tax credit is the lower of the amounts A and B that you see on the screen. So it's a lower of the actual amount of tax paid on the foreign source income in the foreign jurisdiction, and the amount of the corporate tax due on that foreign source income net of related expenses. So we compare always to the net income that is due on that foreign source income. And the foreign tax credit is always paid according to the formula that you see on the screen, and of course this is also available under a comprehensive guide on foreign tax credit. So basically, if you receive an interest from a foreign jurisdiction, the interest is subject to withholding tax in the foreign jurisdiction at the rate of 5%, and then the interest is taxable in the UAE at the rate of 9%. Then in that case, of course, you will get a foreign tax credit based on this formula. One important requirement is that the foreign source income should be taxable in the UAE. If you get a dividend from a foreign participating interest, and this dividend is exempt in the UAE, so it has been subject to withholding tax in the foreign country, so 100 of dividends, subject to 5% withholding tax or 10% withholding tax in the foreign country. If this dividend is exempt in the UAE because of the participation exemption requirement, then of course one of the requirements for the foreign tax credit is not met because the foreign source income is not taxable in the UAE, then it will not be eligible to any foreign tax credit. Tax loss relief, I think this is also a very significant, advantage or relief available under the corporate tax law. So basically, if the deductible expenditure of a taxable person, they exceed his taxable income, then we will be in a loss position, and the tax losses can be used to reduce the taxable income in future tax period up to a maximum of 75% of the taxable income for each subsequent period. So tax losses, they can be carried forward, of course, and definitely, which is a big advantage under the corporate tax law. And against this, of course, there is a cap in terms of carry forward of losses, and there are also requirements or conditions. So the cap is 75% of the taxable income of the year in respect of which you want to claim those losses. Also, you need to maintain kind of stable ownership. So basically, and utilize the tax losses, they can be carried forward, and definitely if there is no change of ownership of more than 50%, so the ownership of the entity carrying forward the losses should not change of more than 50%. Or if there is a change of ownership, the taxable person continues to conduct the same or similar business activities. So even if, for example, from year 1 to year 2, more than 50% of the ownership changed because of the transfer from the, the first owner to another owner, you can still carry forward losses if you continue to conduct the same or similar business activities. Tax losses incurred, of course, before CT, they are not carried forward, and they cannot be eligible for the tax loss relief. Tax losses that are incurred before a person becomes a taxable person, also they cannot be claimed. So if you are an exempt person in year 2024, you incurred losses of 10 million in year 2024, then in year 2025 you lost your exempt person status, then the losses of year 2024, you cannot carry them forward to year 2025 because you were an exempt person, and then if you are an exempt person, you cannot take those losses to a period where you are not anymore an exempt person. Also, assets or activities, losses that are derived from assets or activities which generate exempt income, they are not eligible for the loss relief. Maybe an example on the tax loss relief. So if in year 1, a parent company owes 100% of a subsidiary, and the subsidiary has a tax loss of 100 million, so in year 2, the company, the subsidiary has a taxable income of 20 million. So the tax loss of 100 million in year 1 could be carried forward to year 2, subject to 75% of the taxable income of year 2, which is 75% of 20, which is 15 million. And then the balance will be the taxable income for year 2 for the subsidiary, and the difference, which is 100 minus 15, could be eligible for carry forward to year 3 and the following years, subject to meeting the ownership requirement, the maintaining the same ownership, which is requiring that you should not change more than 50% of your ownership at the level of the subsidiary, at the level of the person claiming the tax loss relief. And even if more than 50% of the ownership has changed, you can still carry forward losses if you keep on conducting the same or similar business activities. And I will hand over to my colleague Zubair to talk about the provision related to groups, so transfer, qualifying group, business restructuring, and also transfer of tax losses and tax group regime. Thank you.
Thank you, Rida. Thank you very much, Rida. I will be talking to you about groups now. So this is not only tax groups, but the different groups available or considered under the corporate tax law. And as Rida's just mentioned, we have something called qualifying groups, which are very different and distinct from tax groups. We also have business restructuring relief, transfer of tax losses, and then we will come on to tax groups. Now, these 4 areas are quite technical. We have 3 guides, a guide on qualifying group relief, business restructuring relief, and tax groups. So for this presentation, I'm going to talk you through the conditions, how you can avail these benefits, these reliefs, and how a tax group may be formed, what the conditions of each of these scenarios is. So let's start with transfers within a qualifying group. So this is provided for by Article 26 of the Corporate Tax Law and Ministerial Decision 132 of 2023. The guide labels this as qualifying group relief, and that's what it's informally known as. So what does qualifying group relief allow? It means if a qualifying group exists, there are taxable persons who are within a qualifying group, then any assets or liabilities which are transferred in that qualifying group, there will be no tax implications. It will be treated as a no gain or no loss transfer. And the way that is done is by transferring at the net book value. So rather than transferring at the market value, the transfer will be done at the net book value. So what are the conditions? For a qualifying group to exist, they need to be juridical persons. So they need to be incorporated entities. And that can be both resident persons or non-resident persons with permanent establishments in the UAE. Now, in terms of the ownership structure, so for qualifying groups, the figure to remember is 75%. This is different from tax groups, which has a higher threshold of 95%. For qualifying groups, for a qualifying group to exist, there needs to be 75% ownership between the relevant taxable persons, or alternatively, a third taxable person can have ownership of 75% directly or indirectly of the other two taxable persons. And those two taxable persons will be considered as being in a qualifying group. So those are the two scenarios, either a connection between the taxable persons themselves, or a third person has that relationship between those two taxable persons. It has the ownership of 75%. The persons or the taxable persons cannot be a qualifying free zone person. They cannot be exempt persons. Those categories will never be able to form part of a qualifying group. So qualifying group will never apply to them or any transfers between them, even if the ownership conditions are met. The financial year, it must end on the same date, and the accounting standards adopted by those taxable persons must be the same. Now, the important point to note about qualifying groups, there is no creation or effective election to create a qualifying group, as there is with tax groups. For qualifying groups to exist, they need to meet the conditions, and if they do, they may be eligible for qualifying group relief, or as per Article 26, transfers within a qualifying group. That's one important point to note. Now, the value of the transfer. So if a transfer is made, then they will be treated, as I mentioned, at the net book value. So there will be no tax implications on that transfer if structured in this way and the conditions are met. The election. As I mentioned just now, there is no election to form a qualifying group. But that specific transfer which happens, there must be an election made on that transfer for this relief to apply. And it's only once the transfer is made that this will have no tax implications on said transfer. But qualifying group relief doesn't necessarily end there. The following 2 years are relevant, and this is referred to as the clawback provisions. There are instances where if certain factors affect said transfer within those following 2 years, then that relief will be clawed back. So firstly, what are those conditions? What may cause a clawback to come into play? Well, firstly, if any of those taxable persons, the ones that we mentioned who are in a qualifying group, if they leave that qualifying group within a period of 2 years. If they do, the relief is clawed back and there will be a tax consequence by virtue of them leaving the qualifying group. Secondly, if those assets or liabilities which were transferred in the qualifying group leave the qualifying group, that also causes a clawback of the qualifying group relief. And again, there will be a tax consequence by virtue of there being a no gain or no loss on the initial transfer, that will now come within the scope of corporate tax, and there will be tax on that previous transfer due to the asset or liability now leaving the qualifying group. So the key highlights to note, or distinctions to note, with a qualifying group versus the other provisions such as tax group: there is no election to be made to have a qualifying group. A qualifying group will exist if the conditions are met. And the conditions can be found in Article 26 of the Corporate Tax Law, and as mentioned before, Ministerial Decision 132 of 2023. The election is only made when a transfer is made where both parties wish to benefit from this relief. Business restructuring relief. This is found in Article 27 of the Corporate Tax Law and Ministerial Decision 133 of 2023. Business restructuring relief is in the Corporate Tax Law to allow restructurings to happen and not to impend on those due to tax consequences. And so it will mitigate potential tax effects of restructurings from happening within various group formations. So here are the conditions. In the first condition, the restructuring must be in accordance with the UAE laws. And that is not the corporate tax law. That's the underlying laws which apply across the UAE, may apply across different free zones. Although qualifying free zones may not be applicable, free zones may benefit from, free zone persons may benefit from this relief. So the applicable rules across the UAE must be abided by. The second requirement, as was the case for qualifying groups, it applies to resident persons or non-resident persons with a permanent establishment in the UAE. Exempt persons cannot benefit from business restructuring relief, neither can qualifying free zone persons. So as I've mentioned a couple of times, the distinction between a qualifying free zone person and a free zone person are relevant here also. The financial year must end on the same date. For any taxable persons which are trying to restructure, their financial year must have the same end date for when they are carrying out the restructure. And the financial statements must be created on the basis of the same accounting standards. And the final condition, for business restructuring relief, it must be for valid commercial reasons. And it must reflect the economic reality. If it's suspected that there are tax reasons and not legitimate business reasons for doing the business restructure, it may be the case that business restructuring relief will not be applicable to said restructuring. So how does it work? Business restructuring relief applies to either the transfer of a whole business or an independent part of a business. And when we're considering the independent part of a business, we're looking and considering whether that independent part can be carried on identifiable and separately to the rest of the business. And this consideration is covered extensively in the guide, and it's, for now, the point to take away is it either should be a whole business or an independent part of a business which is capable of being a business in its own right. The effect of using BRR, of using business restructuring relief, will be that the assets and liabilities are transferred at their net book value. So there will be no tax consequences of said restructuring. And again, there are conditions to be met after the transfer. Just as was the case for qualifying groups, for a business restructuring, in the 2 years that follow, any shares or ownership interest should remain part of the same company or group for at least a period of 2 years. The second point to note, if the recipient is receiving any other consideration which is possible under business restructuring relief, it cannot exceed the lower of the net book value or 10% of the nominal value of the shares exchanged. And briefly, there's an impact on losses. So business restructuring will apply to businesses or independent part of businesses. And if that business has losses, as Rida has just mentioned, if they crystallize tax losses, they will be able to carry them forward. They can carry them into the restructuring, into the business, and they will keep those losses. For an independent part of a business, if those losses can be identified as part of that independent business's losses that it has generated in the past, then those will also be kept with that independent part of the business. And final point on business restructuring relief, the relief is applicable by election. So if there is a restructuring without making an election, without meeting the conditions, there may be tax implications. But if the conditions are met and an election is made, there will be no tax consequences due to the fact that the transfer will be done on a no gain and no loss basis. Transfers of tax losses. This is found in Article 38 of the Corporate Tax Law, and there are a number of conditions which need to be met in order for the transfer of tax losses to happen. So, both persons who are the ones transferring from and to for the tax loss must be resident persons and they must be juridical persons. So this provision does not apply to natural persons. It's for juridical persons. The ownership condition here also, as with a qualifying group, is 75%. So 75% in the other entity, or a third person has 75% ownership in each of the taxable persons, which the loss is being transferred from and to. Again, as highlighted by the diagram, there's a carve-out. It does not apply to qualifying free zone persons. It does not apply to exempt persons. And we also have a non-resident subsidiary. So we mentioned before, it only applies to resident persons. So these three entities would not be able to transfer any tax losses. The financial year end must be the same, and the accounting standards must be the same of the entities, of the juridical persons which are transferring the tax losses. And a final point to note. So as Rida has just covered, when using tax losses, you can utilize up to 75% of the tax loss to reduce your income by up to 75%. And that provision is also applicable here. If a loss is being transferred, the maximum amount that can be transferred is 75% of the taxable income of the recipient. So although the example given before and discussed by Rida was an entity using its own tax loss, even when it's transferred to another taxable person, to another resident person, you have to also be mindful that it can only reduce, and the amount only can be transferred is 75% of the taxable income of the recipient. And finally, tax groups. Tax groups are defined under Article 1 of the Corporate Tax Law as two or more persons which are treated as a single taxable person. And this is covered in Article 40 of the Corporate Tax Law and Ministerial Decision 125 of 2023. And that is the overriding position of tax groups. By having a tax group, you are treated as a single taxable person. And this is very different from the categories I've just discussed. The ownership requirement is a lot higher. It requires 95% ownership. Also, a tax group has to be formed. It doesn't exist like a qualifying group will. A tax group in itself has to be elected for. There needs to be the creation of a tax group to avail the treatment to be treated as a tax group. So we can talk now about the conditions to qualify as a tax group, and these are provided by Article 40. So Article 41A covers resident. They need to be resident juridical persons in the UAE. If they are resident, they can form part of a tax group. Non-residents will not be able to join a tax group. Now, there are specific instances if you are resident in more than one jurisdiction, such as the UAE and another jurisdiction, and that is dealt with by Article 3 of Ministerial Decision 125, which considers situations where there's residency in two jurisdictions, one of which is the UAE. Now, the ownership conditions. So the parent company has to hold at least 95% of the share capital and the voting rights. And that's covered by Article 40, Clause 1B and C. The parent company has to directly or indirectly, through a subsidiary, hold 95% in each of the subsidiaries. And the next point, they must be entitled to at least 95% of the directly or indirectly, the profits and the net assets of the subsidiary. Again, that needs to be held directly or indirectly through a subsidiary. Again, exempt persons and qualifying free zone persons are carved out. That's Article 41E and F. They are not able to join a tax group. If they lose their exempt person status, or they're no longer a qualifying free zone person, they are just a free zone person, then they can join and be part of a tax group. Also, the financial year must be the same for each entity which is joining a tax group. And it's a minor distinction, which is an important one to make between qualifying groups. For tax group, the financial year in its entirety must be the same. It's not the financial year end. The financial year, the start and the end must be the same to be part of a tax group. And the accounting standards also have to be the same. So whether IFRS or IFRS SMEs, they need to follow the same accounting standards to be part of a tax group. So, if a tax group is formed, what are the parent company's responsibilities? Well, they represent the tax group. So if there's any changes, any filings, they are the entity which is responsible. So they need to file the corporate tax return, and they need to pay any corporate tax due on behalf of the tax group. That is the parent company's responsibility. Also, if any subsidiaries are leaving or joining the tax group, if the tax group is ceasing to exist as a whole, or even if the parent entity is being replaced, all of which are accommodated by Article 40 and Ministerial Decision 125, then the parent company is responsible for these changes. The taxable income of a tax group. So this is covered extensively in the tax group guide, but the parent company will consolidate the financial results of the tax group, considering the financial results, assets, and liabilities, and then eliminate any transactions between the parent and subsidiary or between any of the subsidiaries themselves. And that will provide the taxable income for the group as a whole. And as I mentioned right at the start, they're considered a single taxable person. So they will have taxable income as a tax group as a whole. When there's an application, the application is made by the parent company and all of the subsidiaries. And that is available on the Amara Tax platform. So if a tax group is being formed, they can do so after registering in the first instance. And that's an important point to note. When you are joining a tax group, all of the entities first and foremost need to be registered. And it's once they are registered, that's when they go on to proceed and form a tax group. And that can be done, as I mentioned, through the AmaraTax platform. The tax liability. When there is CT due, the parent company and all of the subsidiaries are jointly and severally liable for any liability which remains outstanding to the FTA. So these are the conditions. We're going to put these in a brief diagram, a simple diagram to outline who can be part of a tax group and who cannot be part of a tax group. So on the right-hand side of the slide, we have two subsidiaries which are 100% owned by our parent company. So if we work through the criteria, we have a parent company who is UAE resident. Both subsidiaries are also resident, so they meet the resident condition. Given that there's 100% ownership, we consider that the share capital, voting rights, profit, and asset conditions are met, B, C, and D, of Article 40, Clause 1, so they can form a tax group. Now, these entities here in red cannot form part of a tax group, and the reason for each of them is different. So firstly, we have a resident mainland subsidiary, but the condition of 95% is not met. Here we have a 75% shareholding. So if we step back a few slides, they may form part of a qualifying group, but they would not form part of a tax group. We have a non-resident subsidiary. They're not considered resident in the UAE, and so they will not form part of the tax group. And then we have an exempt person and a qualifying free zone person. And as provided by Article 41, these two entities will not be allowed to form part of the tax group. So that brings the group provisions to an end. There are some important distinctions to note between the different variations of groups available. Tax groups are formalized through an application. They're treated as a single taxable person. The other categories, whether it's transfers within qualifying groups, whether it's business restructuring, or whether transfers of tax losses, are by election or transfer of those specific transactions. It's only tax groups which require the formation of a tax group in itself, and that's reflected by the additional conditions and the higher requirements of ownership. Thank you very much. I will pass on to Christine.
Thank you. Okay, I understand we have gone a little bit over time, so I will try to rush past this part of the presentation. Not that it's not important, compliance requirements are very integral to the whole process. A lot of you will also already be familiar with compliance requirements for VAT. So what I'll do here in this section is just try to highlight some of the similarities and the differences between compliance for VAT and compliance for corporate tax. Very quickly, so Vidas went through how to determine your taxable income. The starting point for doing that is your accounting net profit and loss. How you determine your accounting net profit and loss, that has to be done using the accounting standards that are accepted in the UAE. So under corporate tax, the law and the decisions issued in relation to that state that international financial reporting standards are the applicable accounting standards. So everyone must use IFRS. The exception to that is if that you have revenue of less than 50 million, you can use the IFRS standards for small and medium-sized enterprises. So if you are a branch of a foreign company and you're using a different accounting standard, say for instance you're using US GAAP, that branch does need to prepare their financial statements using IFRS. The accounting basis. So Rita went through some of the elections that are possibly to be made, but everyone is required to prepare their financial statements using the accruals basis. There are two exceptions, and it's also to help the smaller businesses. So if you're a small business with revenue of less than 3 million dirhams, you can use the cash basis. If there are exceptional reasons why you can't use the accruals basis, you can also apply and get approval from the FTA. Okay, tax returns. There's a few people who've seen, I think, a tax return is circulating around. So tax returns are available to be filed obviously only people who have completed the tax period or have ceased activity need to file a tax return. So for VAT, you had 28 days from the end of a tax period to file your tax return. For corporate tax, you're being given 9 months. So you have 9 months to finalise all your book of accounts, your financial statements, prepare all your documentation, and file your tax return. Same as VAT, it will be filed on Tax, and certain information will be collected from you. So there's the details there, but obviously it's going to be that you will need to have maintained all your information, your transaction data, things like that, to be able to support any of the figures that you report in the tax return. Again, similar to VAT, all transactions need to be denoted in the United Arab Emirates dirhams. So the exchange rates that you can use are published on the Central Bank of the UAE's website. And for transactions, we want everyone using the spot rate that's available on the transaction date. Now, if that is impractical to use, the spot rate, you can use the average monthly exchange rate. Now, if that is also impractical, then you can use the average annual exchange rate. Okay. The due dates for payments of your tax is, so for VAT, again, it's the same date that your tax return is due. So for VAT, you have 28 days to file, you have 28 days to pay. Same thing for corporate tax. You have 9 months to file, 9 months to pay. And in very limited situations, will there ever be really a corporate tax refund, given that we don't have a withholding tax, but that is also a possibility, also done through Tax. Documentation. It is critical to maintain documentation to be able to support any of your transactions. So most of the requirements for documentation are in the tax procedures law, but there are some differences for corporate tax. So for corporate tax, you have to prepare financial statements. Those may need to be submitted with your tax return or be asked by the FTA at a later time. So you have to make sure that you maintain that throughout the period. Transfer pricing documentation, Rita went through, so I won't go through that, but you can be asked to provide that at any point, and then you have 30 days to hand that over. But you also will be required to provide some sort of schedule with the tax return in relation to your transactions with related parties. And then finally, a difference between VAT and corporate tax, apologies for the squeaking, is for VAT, you're required to maintain your documentation for 5 years. For corporate tax, the TPL actually says it's 5 years or whatever's determined by the separate tax law. Corporate tax law specifies that you must maintain your documentation for 7 years from the end of the relevant tax period. So please ensure that you don't throw it out too early. Okay, now I'll quickly wrap up. The FTA, as His Excellency Al-Bustani said, we want to do as much as we can to support the taxpayers. We know there's a lot of information. We are also issuing as many guides as possible. So Free Zone Guide came out. There are still more guides coming, so stay tuned. We're also trying to have as many awareness sessions. So the next sessions that we will be having will be dedicated to free zones. I see a lot of familiar faces, so most of the content will be new content for you as well. But one of the things that we do want to highlight is that you have the option of submitting a private clarification. So if you are a taxable person, or any person really, but if you meet the conditions, and it's really important that you read the service card that's available on Amara Tax, if you meet the conditions to submit a private clarification, please do. And we'll respond to you on that. But when you do that, make sure that you complete the form correctly. You are the relevant taxable person. So, for instance, if you are part of a VAT group now, and the representative member of the VAT group normally submits that VAT, all your tax returns and also files the VAT clarification, if you have a private clarification request for VAT, that VAT representative member cannot submit the private clarification for another member of the VAT group, even though they can do that for VAT. Because for corporate tax, you're still separate taxable persons, And unless you have elected to form a tax group, only in that situation can a parent entity submit a tax return, a private clarification request on behalf of a subsidiary or another member. Same thing for tax agents or tax advisors or anything like that. Only the authorised person, so the taxable person, and the authorised signatory or legal representative can submit a private clarification request on behalf of another taxable person. And that's because of confidentiality reasons and because you're required to be a party to the transaction and it has to impact you directly. Please make sure that the questions are clear, that you provide your technical analysis. We are hoping that a lot of the questions that we have received, the guides that have been issued subsequently have addressed those questions. We hope that the free zone guide has addressed a lot of the questions that people have in relation to the free zones. So please take your time to read that. We're giving everyone time to digest that and then come and have the awareness sessions specific to free zones. But if there is anything, you can submit a private clarification as well. And it's really important that we want to be able to issue you with a decision as quickly as possible. So the better and more information you actually provide us up front will mean the quicker that we can respond to you as well. Okay, on that note, I'll hand over to Juliana, who's going to go over the very final part of the presentation, which is the registration and deregistration rules and process, and deadlines most importantly.
Thank you, Christine.
Thank you.
Hi everyone. So last but not least, we're just gonna quickly guide you through the different timelines for registration. This was the first point mentioned by His Excellency this morning. He urged all the business to register in advance, and this is just to make sure that the system runs smoothly. We can process your registration application smoothly, so that's why we highly encourage all the business to register as soon as possible. And now with the FTA decision 3/2024, we have now clear deadlines for registration. But just to recapitulate, resident persons need to register for corporate tax purpose based on the date their license was issued. So in case of business incorporated or established or recognized prior to 1st of March 2024, they must register for corporate tax based on the month which the license was issued. And I will show you in a few slides a small timetable with the different deadlines. And in the case you have a juridical person that does not have a license issued, then you have to register within 3 months from the date when the decision has become effective, which is now by 31st of May. So we have a number of business that will have to register now by 31st of May. In the case of business incorporated, established, or recognized after 1st of March 2024, they have to register within 3 months from the date of incorporation, establishment, or recognition. Just quickly show you this timetable. You might have seen, because it's taken from FTA decision number 3, just show you different deadlines according to the date where the license was issued, and the idea is just so the system runs smoothly. We have this wave of applications based on the date of the license was issued. And here, just a few points for non-resident persons, because sometimes we receive a number of queries from non-resident persons, whether they should register or not. So just to make clear, in the case of non-resident persons due to have a permanent establishment in the UAE, in the case the permanent establishment relates to prior to 1st of March 2024, in this case, registration must happen within 9 months from the date where it was recognized that there is a permanent establishment in the UAE. In the case of permanent establishment after 1st of March 2024, Then the permanent establishment, this business has a period of 6 months from the date of existence of the PE in order to register for corporate tax purposes. In the case of Nexus, which is the second possibility of a non-resident person that will be required to be registered for corporate tax purposes, in the case of Nexus prior to 1st of March 2024, the non-resident person must register by 31st of May, so it's coming up. In the case of a Nexus after 1st of March 2024, then the non-resident person needs to apply to register within 3 months from the establishment of the Nexus. And just a final point on natural persons. In the case of a natural person, which is considered a resident person, by conducting a business or business activity in the UAE, registration needs to be by 31st of March from the following Gregorian calendar year, by the time where it was reached the threshold, because as we saw, for natural persons, they only have to register in the case the turnover exceeds the threshold specified by the cabinet decision, which is 1 million dirhams. So once this threshold is reached by the following calendar year, by 31st of March of the following calendar year, then the natural person needs to register for corporate tax purposes. And a final one, in the case of non-resident, this deadline will be 3 months from the date of fulfilling the conditions of the taxable persons to be considered as a taxable persons for the purpose of corporate tax law. And with that, I'll give the word back to Ruda. Thank you, Ruda.
Thank you so much. Thank you so much to our experts. We now move to an important part of today's agenda. We will be gladly responding to your inquiries and questions about corporate tax. When registering for this workshop, many of you have asked questions, and the team of experts will now answer all the questions raised as I join them. So, starting with the first question to Christine. Is corporate tax registration mandatory even if my taxable income is less than 375 dirhams and I'm not registered for VAT?
Yes, so I want to make a big distinction here when it comes to the 375,000 threshold. So for VAT, that is the mandatory registration threshold. But for CT, there's no such thing as a threshold, except for natural persons. So for all juridical persons, as long as you conduct a business and you meet the requirements of being a taxable person in the UAE, you are required to register, and the 375,000 dirham threshold doesn't apply. That's only for corporate tax purposes. The 375,000 threshold is the tax-free component. So it's the first 375,000 dirhams of taxable income that a person can make that's going to be subject to 0%, and everything above that is subject to 9%. But you must register even if you are not registered for VAT, if you are a business.
Thank you so much, Christine. Rida, how can a sole establishment register for corporate tax?
Thank you, Ruda. So a sole establishment will be always registered as a natural person. As we said, for natural person, the first corporate tax period will be tax period 2024. So for natural person conducting business and business activity 2023, this will not be subject to corporate tax. Again, the first tax period will be 2024. If they reach 1 million during 2024, they can go and register for corporate tax. Otherwise, their deadline for natural person will be 31st of March 2025. So there is plenty of time for them to register for corporate tax. Okay?
Thank you so much. Moving to the next question. In 2024, a natural person started a new business through an LLC, where he owns 100% of the capital single owner LLC. Zubair, should the natural person register for corporate tax purposes?
So, in this question, we have a natural person who's an individual, and they've set up a company. The company, as a juridical person, needs to register in their own right, not the natural person. However, the natural person needs to consider his own business or business activities. If they are conducting such, they reach the threshold of 1 million dirhams, as we covered earlier, then they would also have to register. But simply by virtue of setting up an LLC where they're holding the capital, they're holding the shares, the natural person will not have to register for corporate tax.
Thank you so much, clear enough. Moving to Juliana. When a qualifying free zone person elects to be subject to corporate tax, is the election irrevocable, or can the taxable person elect in and elect out in different financial years? For example, can I elect to be subject to 9% in my first tax period and then be subject to 0% for the next tax period?
In this case, the election is going to be for the tax period to which they are electing and for the subsequent 4 tax periods. So they cannot simply elect 1 year and then change it to elect differently for the following year. They have to follow the election for that year itself and for the subsequent 4 following years.
Thank you so much. Rida, if I'm an incorporated in a free zone and my activity is a qualifying activity, so my income will be subject to 0% tax, do I still need to register for corporate tax?
Thank you. So all juridical persons that are incorporated in free zones, they are considered as resident person. They need to register for corporate tax purposes. And then once you register, you get your TRN. Then if you meet all the conditions for being a qualifying free zone person, then you can claim your 0% on your qualifying income. But the obligation to register is there for all juridical persons, so companies considered as a resident person incorporated in UAE or deriving their status from UAE law.
Thank you so much. Moving back to Christine. Is corporate tax applicable on a company in a designated zone that only does high sea sales or port-to-port sales?
Just explained, if you're registered in a free zone, you're required to register. So it doesn't matter if your activities are going to be qualifying activities or all your income is qualifying income, you actually still need to register. So high sea sales, port-to-port sales, if you're, that is going to be qualifying activity and qualifying income subject to 0%, but you still need to register and file your tax return.
Thank you so much. Moving to the next question. How do I know if the commodities I trade in are qualifying commodities, Juliana?
Thank you, Ruda. No, it's okay. So we have to consider 3 factors in this case in order to be considered as a qualifying commodity. First, the type of commodity, if it's metals, minerals, energy, or agricultural commodities, that they are in a raw form, so they didn't pass through a detailed transformation. And third, that they are traded in a recognized exchange market, either in the UAE or abroad. These are the 3 conditions.
Thank you so much. Rida, should taxable income be calculated based on audited financial statements only?
So audited financial statement, they should be provided in 2 situations. Qualifying free zone person, in all situations, so it's one of the requirements to be a qualifying free zone person is to provide audited financial statement, irrespective of the level of the revenues. This is the first situation. The second situation is for all taxable person with a revenue equal to or exceeding 50 million UAE dirham during a tax period. So these are the 2 situations where audited financial statement need to be provided. Otherwise, you need to just provide financial statement as per IFRS or IFRS for SMEs.
Thank you so much. Moving back to Christine, if a natural person's taxable income does not exceed million dirhams, are they required to register and file a tax return?
So Zubair, again, I want to highlight just the terminology used here. So they refer to the taxable income not exceeding 1 million. When it comes to looking at whether or not a natural person needs to register for corporate tax, it's necessary to consider the turnover. So we went through, or Zubair went through earlier, what consists of turnover and what's excluded from turnover. But if your turnover exceeds 1 million as a natural person, then you are required to register for corporate tax and file tax returns.
Thank you so much. Moving to the next question. If an individuals are not taxed on their salaries, so can a company decide to grant enormous salary to the managing director, who is the owner, and avoid profit in its bookkeeping? Rida?
So as we said, so a managing director or director is a connected person. So all the transaction with the company, with a taxable person, will be considered as a transaction with a connected person subject to the arm's length principle. So the deductibility will be limited by or subject to the transfer pricing rules and subject to the arm's length principle. So the remuneration should be an arm's length remuneration.
Thank you. And what if can an owner of a sole establishment pay themselves a salary and deduct it as an expense?
So they can always pay a salary, but it's not deductible as per Article 33, I think 5 of the corporate tax law. And it applies also to partners in an unincorporated partnership if they they withdraw from their also partnership.
Clear enough. Thank you so much. Zubair, are employees' bonuses considered as an expense?
So yes, if there is a bonus paid to any employees, if that's deductible in the accounts, that will also be deductible for corporate tax profits. The only point to mention on this, where there might be an exception, is just what Rida has just mentioned. So, connected persons, related parties, there may be instances where this expense is not allowable for corporate tax purposes. But the general rule is that it will be an allowable expense as per the accounts.
Thank you so much. Christine, will depreciation of an asset be deductible expenditure? If yes, are there separate depreciation rates for corporate tax purposes?
So the good answer here is that there's no separate tax depreciation or effective lives for tax purposes. So you can just follow the accounting effective life that you use under IFRS standards and use that, and that's deductible for corporate tax purposes as well. The one thing that I will highlight here is it's also still subject to the normal general deduction rules. So, accounting depreciation and the effective life for that can be used deductible in your tax return.
Thank you so much. Moving back to Zubair, can any company or natural person elect for the small business relief, or will the FTA inform them whether they are eligible?
So, the FTA will not inform natural persons or juridical persons. This is self-assessed. Natural persons, juridical persons, they need to consider their revenue in the tax period. If they meet all of the other conditions also, then at the time of the return, that's when they can elect for small business relief. The FTA will not notify or state anything to the individuals or the companies. They need to elect for it themselves at the time of the tax return.
Thank you so much. Rida, can tax losses be carried forward indefinitely?
Yes, tax losses, they can be carried forward indefinitely, and they will be always subject to two conditions: a cap with respect to the amount of the loss, which is 75% of the taxable income of the year in respect of which you claim the tax loss relief, and also condition about ownership. So you need to maintain more than 50% of the ownership staple, and if the ownership change, you need to keep the same or similar business activity.
Thank you so much. Zubair, can tax losses be partially utilized, for example, up to the 375 threshold?
When you are utilizing a tax loss, there is no partial utilization allowed at all. If you're using a loss in that year, it will decrease your income. If you have the loss there, it will decrease it to zero. If you have a lower amount of a loss, then obviously that will only reduce your income to a set amount, but it cannot be a partial utilization. It's all or nothing when utilizing a tax loss that's been brought forward.
Thank you so much. Rida, can a subsidiary join or leave a tax group midway through the financial year?
So this is possible, but joining or leaving the tax group will be effective from the tax period that is specified in the application to join or to leave a tax group as per the provision of the corporate tax law.
Thank you so much. Ladies and gentlemen.
And I wanted, sorry, to mention that also tax group, you can apply for tax group. Now the model is available on Imara Tax. It has been available for a certain period of time, I think since now 3 months and a half, okay?
Thank you so much, Rida. Ladies and gentlemen, we would like to require you to open your cameras and scan the QR code for us to enable us to listen to your recommendations and your feedback about the overall organization of today's event, and if you would like to attend future workshops as well. So we will give you 2 minutes to do the survey. Okay, so thank you so much for participating in the survey. As our time ran out and we are approaching the end of the workshop, we tried to answer as many questions as possible. And we assure you that the Federal Tax Authority team will be keen to answer all remaining questions, and when necessary, the frequently asked questions section on the FTA's website will be updated. Thank you again for joining us today, and we also thank those who shared their important questions. Thank you and have a lovely day. Thank you.